Right, I think we're good to go. Good morning, ladies and gentlemen. Warm welcome to the BCI Investment Conference here at Harsendal, Cape Town. Great to see so many of you in person again. Beats the hell out of staring at a laptop screen, doesn't it? Right. From the BCI team side, from Olga, Tanya, Robert Walton, thank you so much for all of you being here today. And thank you for your continued support in making BCI a mammoth success. Over the past 11 years, we managed to grow to the third largest manco in the country. And it's not because we're so smart or clever, it's because of your contribution and your continued support and the great work being done by all our investment partners or investment managers. With that said, thank you for all our speakers here today in advance, for the time you took out of your busy schedules in being here. But more so, the time that you took in preparing for these sessions. We know there's a tremendous amount of work going into your presentations. We only give you 15 to 20 minutes, high impact presentations, a lot of work going in there, and it's always going back to the drawing board and says, no, I need to cut slides, but I don't want to cut slides because my message is really valuable. Just a few quick house rules before we get proceedings underway. I'm sure most of you scanned in already for this valuable CPD points. If you have not done so yet, QR codes on the screen, you can scan in quickly. And when you leave today again, just make sure that you scan out again. Olga, Tanya and the team again made for a wonderful agenda this morning with some of the top investment minds in the country coming to share their views on anything from SA equity. We're going to touch on global equity, SA fixed income. And I think a lot of questions from your clients at the moment as well, because everything seems to do well. Yes, there's been a little bit of volatility over the past 3 or 4 weeks, but year to date, everything is up, everything is in the green. SA equity had a phenomenal time, especially financials. SA fixed income is really running ahead. The bond sector did well. SA property did extremely well. Global property did well. So the question, I think, from a lot of clients is, do I need to buy more if I didn't have enough of this stuff? Or, is this the beginning of the end? What can we expect going ahead? Are all the risks out of the market? Or are the planets aligning perfectly fine? We still hear talks about recessions and soft landings. We still talk about things like high debt levels globally. And we're seeing some cracks in the US market. Where is this all going? And questions as well that we're going to address today is, will the Fed cut rates on the 18th, and where will the world or central banks go with rates from this point forward? And I'm sure a lot of the message you're going to hear today is you can't forecast these things. You've got to employ a sensible fund manager to actually navigate through these waters. With that being said, it's my privilege to welcome our guest speaker for the day, all the way from London, Chief Investment Officer at Credo, Dion Gous. I'm sure you're all familiar with Dion Gous. It's great to have you here again, Dion, to address us. Maybe just some background. Dion joined Credo in 2012 as Chief Investment Officer, but he's been in the industry from 1996. So Dion's been around for quite some time, been through a couple of cycles with a lot of insight in terms of how they see the world and what to look for, what not to look for. Prior to joining the industry, Dion lectured accountancy at the University of Johannesburg, and he's got his MPhil in finance from the University of Cape Town and a CFA charter holder. Dion's also extremely well published in a lot of media circles, including the Financial Mail, including a book that I'm sure he's going to make mention of as well. And it's great to have Dion here to address you this morning. Dion, I've got very bright lights in my eyes. There you are. I can't see you. You're welcome to come to the stage. Thank you very much.
I want to start by saying this is not a presentation about Marcus Jooste. This is not about knocking a man when he's dead. This was originally articulated and presented at the Investment Forum in both Johannesburg and Cape Town to about 1,500 people. I know there are people in the room that have heard this. Please forgive me if you're going to hear some repetition today. The good news is that you've probably forgotten what I said before. I certainly have, and I can't wait to hear what I'm going to say next. But I've also updated it slightly in places. It's also shorter than it was at the Investment Forum, because Eugene is tired of my voice by this time. So, as I said, this is not about Marcus. This is really just the title is taken from, and the reference is taken from one small piece of the presentation. There's only 1 or 2 slides about that. It's about all sorts of other things. So I'm going to start by saying that this presentation, The Wolf of Dorp Street, and the title of it takes its inspiration from, of course, the movie, The Wolf of Wall Street, which was released in 2013, arguably the most important and best movie of financial services of all time. But it's not the only movie that is relevant today. There's also The Big Short that was released about 2 years later, and where we celebrated the global financial crisis that all of us enjoyed together in 2008. And then there's a movie about a very underappreciated and often misunderstood part of financial services, namely the American Mafia, The Godfather. And then finally, there's 50 Shades of Grey, which I have to confess, I'm not 100% sure this is a financial movie because I've never seen it. But I can tell you that it's my wife's favorite movie. She's watched it 14 times on Amazon Prime. And she tells me it's about the London weather. It does have some relevance, and all will be revealed in a minute. So I'm going to start with The Big Short. And if you can read the font here, this is the opening scene of The Big Short. You can go and re-watch the movie on Netflix. You'll confirm this. It starts with this Mark Twain quote where it says, "It's not what we don't know that gets us into trouble. It's what we know for sure that just ain't so." So it's your own sort of misconception about what you know for sure that will get you in trouble, that overconfidence. And the irony of this quote is that when you go to www.quoteinvestigator.com, you will see that it was not actually a Mark Twain quote in the first place. There's at least 6 people in history that said a version of this before Mark Twain ever uttered the words. So even your knowledge about this quote just ain't so. And why do I start like that? Well, I'm going to introduce a little bit of grayness today. This is where 50 Shades of Grey features. This is a picture that I took from my loft in London. This was a beautiful summer's day last year in July. And I want to introduce some grayness into topics that are generally accepted and widely followed, and where I want to suggest that perhaps it just ain't so. Perhaps just look at it slightly differently. And please note, I'm not trying to say that everything, that all these rules and that all these practices are totally wrong and that the opposite is true. I'm only introducing grayness, which is what I want you to take away from this slide. Just look at it from a slightly different perspective and entertain some counter-argument and perhaps some doubt about some perceptions around certainty. By the way, on this slide, the font looked fine. It worked very well. Anyway, my topic was originally inspired by a paper which I read 20 years ago by James Montier called The 7 Sins of Fund Management. And essentially, Montier took 7 topics, and he wrote about them, and it's the same theme of what I have today. And you can't read anything there, but the first one that he talks about there is forecasting, and another one that he talks about is about meeting management. And those 2 I share with James Montier. I know you all wondering what the other 5 are. Go and Google it. 7 Sins of Fund Management, Montier. It's a great paper. It's about 100 pages, but if you're that way inclined, this is really good reading. So the 2 that I've highlighted there, forecasting and meeting management, are ones that I share. So I give a personal take on some sins of fund management. So in terms of the generally accepted principles of finance, I'm going to point out the fact that there are all sorts of bad assumptions underlying those. Then I will talk about risk measures and remind you that risk is what you don't know. Focus on forecasting and reminding you that there is in fact no crystal ball. Meeting management, and this is where the Wolf of Dorp Street will feature, and then the fact that the world has too much debt, this perception that the world has too much debt, and commentators telling you the world has got debt of $300 trillion. And whenever I see that on Twitter, I've probably done it 15 times in the last 10 years, I tweet back and I say, who do we owe this money to? To Mars or somebody? And specifically that the US has too much debt. And just to remind people, yes, there's a lot of debt, but there's another side to the balance sheet. So let's start with assumptions. And you probably know the little weak joke about the economist and the physicist and the chemist who are the only 3 survivors of a shipwreck, and they're on an island together, they make friends, they try to survive together. And then a few weeks later, there's another shipwreck. This time, no survivors, but lo and behold, a can of soup rolls out onto the beach. And they're very excited because they're quite hungry after a few weeks. And they say, well, it's great to have a can of soup, but how do we open it? And the physicist says, I'll walk up to that tree, I'll drop the can from a height, it'll pop open, we can have the soup. The chemist said, don't be stupid, you'll spill all the soup. He says, we made fire last night from a few twigs. We'll do it again. We'll put the can inside. It'll pop open. We can have the soup. It'll be warm as well. The economist said, guys, that's not really clever either. The can will explode. We'll lose all the soup. He says, I've got the only elegant solution. Let's just assume a can opener. Now, that sounds bizarre. That is exactly what finance professionals do. Now, you've got no idea what I'm showing you now. But I'm showing you a paper which has his 60th birthday this week. This is arguably the most well-known paper in the history of academic finance. It is the capital asset pricing model articulated by Bill Sharp, released exactly 60 years ago this week, as I said. And this is where it gets really interesting. The capital asset pricing model is ultimately based on a couple of assumptions. The first one is that all borrowing and lending in the market takes place at the same interest rate. Now, we know that's not true. There has to be an interest rate a margin between the two. Otherwise, there would be no banking industry. You're going to see the top 10 of one of the best managers here today. I've seen this presentation a few times this week. They have 5 South African banks in their top 7 holdings. Now, that wouldn't be possible if this assumption was true. And then secondly, the fact that all investors have the same expectations and are rational. Of course, that's not true, because we feel different about stocks and markets. And none of us are rational. You may think you're rational, but you're not. You are human, as am I, which means we suffer from greed and fear and all sorts of biases, and we get depressed and overexcited. That's why we get bubbles and crashes. None of us are rational. And of course, Bill Sharp's a smart guy. So in this paper, he says, needless to say, I'm quoting, I'm reading, these are highly restrictive and undoubtedly unrealistic assumptions. And yet, even though he recognizes that, he continues. He does all sorts of math. It looks even more difficult in that font. And then he draws graphs, which looks even more interesting in that version. And he comes up with the concept of the capital market line and beta and the efficient frontier. You've probably heard of all those things. And we give him the Nobel Prize a few years later. His close buddy, Eugene Farmer, who was interviewed by the FT just a couple of weeks ago, wrote what's arguably the second most famous paper in finance. It's the efficient market hypothesis. This was released in 1969. And once again, there's a few assumptions there. The first one is that there's no transaction costs. So whilst Bill Sharp assumed that the banking industry couldn't exist, Farmer suggests that there would be no stockbroking industry, okay? Because you can't charge for transactions. That all information is freely available. That's not nonsense. There's all sorts of inside knowledge going around. And finally, that people agree on that information. So when Apple releases its results, you and I feel the same way. That's not true, because why are you selling and I'm buying from you? We don't feel the same way about it. We take different sides in every transaction. And yet he needs these assumptions, otherwise the maths don't work. He articulates the model. And by the way, he says himself, he says that we know that these assumptions are not descriptive of markets. Yet he continues, and he gets his Nobel Prize in 2013. So next time that there's a crash, and next time you hear that investment managers explain it away by calling it a Six Sigma event, Six Sigma events, I can tell you for free, should happen about every 10,000 years, except we see them every few months in the market. It's all because the maths underlying those statements is wrong. It's littered with unrealistic assumptions. This leads neatly to the concept of risk. And the picture of the black swan there, I'm not going to go into it. I'm sure most of you have heard it and read it in Taleb's book of the same name. But the black swan, as we know, has become shorthand for the biggest risk out there, the unknown unknowns that we may face up to in our life. The kind of thing that only happens 2 or 3 times in a career. I would argue in my investment career, which is now 29 years, there's been really 2 black swans. And guess what? The financial crisis in 2008 wasn't one of them. Neither was the tech bubble. The 2 black swans, I think, were September 11, which ultimately was irrelevant for the market, and the other one, I think, was the COVID lockdowns. I didn't have a concept that that could happen. And apart from that, everything else is just markets. Anyway, there's a lot of maths that go into risk measures, and the way that people measure volatility and VIX and Sharpe ratios and, I don't know, all these things. And all of it is guilty of a principle which I'm happy to espouse because I'm an accountant myself. Accountants and risk professionals share one thing in common, and that is that they prefer to measure something in precisely incorrect terms rather than substantially correct ones. So accountants are true of that, and risk managers in many cases are true of that. And never is it more prevalent than in the concept of value at risk, which is published by banks and insurance companies and other big financial institutions on a regular basis because they have to, because there's regulatory reasons why they have to do this. Now, if you go and look at the mathematics of value at risk, it's really interesting. Now, life is too short. I'm not going to try and explain this to you. I couldn't if I wanted to. Let's just say that value at risk is the Duckworth-Lewis of the financial industry. It's lots of clever maths. Nobody really understands it, and yet we all accept it blindly. Okay? In the case of Duckworth-Lewis, it's not that dangerous, but in the case of value at risk, it really is. If you go and look at the definition of value at risk, according to the Bible, written by Jorian 25 years ago, this book has seen many editions. He will tell you that the definition of value at risk is that it's the maximum potential loss over a given time horizon for a given confidence interval. So this bank shouldn't lose more than $10 million over the next month, and we are 95% or 99% certain about it. And you can play with those numbers. It just influences the calcs you come up with and the conclusions you bring out. So you'll have that kind of conclusion. But there's an important but here. It's only valid under normal market conditions, which basically means that the value at risk is a great measure, and it will work 99% of the time, the confidence interval there, but that 1% of the time that it won't work is the day that it really matters. Okay, so that's a bit sad. It's a bit like having a car with a safety belt and you drive to work 100 days in a row, and for the first 99 days, you're not in an accident and you arrive safely, and therefore it's a good safety belt because it worked 99% of the time. And then on the final day, you have a catastrophic incident, the safety belt fails, and you're in trouble. But hey, it's not the safety belt's fault. It was a perfectly good safety belt. It worked 99% of the time. And that's exactly how value at risk works in the real world. This is the story to remind us on the concept of risk, of Siegfried and Horn. They used to have this show where they played around on stage with these tigers. And then there was a fateful incident in October 2003 where Manticore, the white tiger on the right, went for Roy Horn, the gentleman with the dark hair in the middle, grabbed him by the neck, pulled him off stage. It was the end of the show. It wasn't part of the show to begin with. They never entertained again, sadly. The auditorium had to close for 6 or 9 months. There was all sorts of court cases and whatnot. And when Taleb, this is a story from the Black Swan book, when Taleb went to the same hotel in Vegas, the Mirage, the risk manager of Mirage made a presentation, and he told people what they used to focus on previously. And it's all the kind of things that you can imagine at a casino. It's to make sure that the tables are balanced and surveillance systems to make sure that the punters don't come and cheat them. But they never had a concept that something like this could happen. And yet the biggest ever loss in the history of Las Vegas happened on stage when this tiger went for Roy Horn's neck. And that just reminds us that risk is what you don't know. It's the unknowns out there. And the same is true in the market. The fact that there's no crystal ball, we all know that, and yet we still entertain these forecasters. It was Jason Zweig who said in the Devil's Financial Dictionary that forecasting is an attempt to predict the unknowable by measuring the irrelevant, a task that in one way or another employs most people on Wall Street. And just to illustrate, this you'll have no concept, nice, colorful Smarty box. This is the Smarty box of asset returns. From left to right, I've got calendar years for the last 10 years. From top to bottom, I've got different asset classes, ranked in order, how they did each year. You'll just have to take my word for it. But dark blue, for example, is REITs. They top in a couple of years, they bottom in a couple of others. Pink is small caps, top, lots of volatility. EM in yellow, top the 1 year, bottom the very next year. Even cash in light blue, top the 1 year, the very bottom of the next year. So this is how volatile asset classes are. And I'm not even focusing on the numbers, if you could read them, but the numbers themselves are all over the place. And yet, we go to Wall Street and we ask these clever strategists, and we know they're clever because we always see that they make $1 million bonuses every year. We ask them, what's your forecast for next year's S&P? There's, I think, about 12 or 15 strategists on here from different firms. And this was for the year 2023, so the previous calendar year. And they were all asked, what do you think the market will do? This was the S&P started the year at about 3,800. This is 2023. On average, they said the market would go up 5.8%, and yet the market went up 24%. It knocked all of them out the water. So the market did much better than any of these forecasters, came up with. The next slide, I'm going to show you the same names, okay? And the fact that you can't read what's there actually helps. But the point is this. They're going to be ranked once again from top to bottom. Top bullish, bearish at the bottom. The numbers on the left, the names on the left-hand side will shuffle because not the same people were bullish 2 years in a row. So it's once again top to bottom, but the numbers on the left will shuffle. So at the beginning of this calendar year, people will ask the same question. When the S&P started at 4,770, on average, people thought the market was going to go up 1%, And of course, in September this year, the market, when I updated this last week, the market was at 5529. When I went to bed last night, the market was at 5554. So that number shifted up a little bit a week later. Okay? So we're already 16% up, even though on average people thought 1%. Now, ladies and gentlemen, I don't make forecasts, but I'll give you a guess. And my guess is that we'll probably end the S&P slightly higher than where we are now. That's my guess, but please don't call it a forecast. And by the way, next time that you see any of these people being interviewed on CNBC or Bloomberg and asked about their forecast for 2025, rather go and watch the cricket on a different channel. It was Warren Buffett who said that forecasters tell you much more about the forecasting tells you more about the forecaster than it tells you anything about the future. And that's especially true if it's a pessimistic, bearish forecaster. It was Morgan Housel who said that pessimism always sounds smarter than optimism, because a pessimist sounds like somebody who's trying to help you avoid trouble or avoid a loss, whereas an optimist sounds like somebody who's trying to sell you something. And that's true even though the fact that it's a fact that probably 80 or 90% it's better to be an optimist, and it pays to be an optimist. The pessimist has their time in the sun every now and then, but not that often. This is my favorite pessimist in the world, Robert Kiyosaki. If I ask for a show of hands around the room, there's probably at least 15 or 20 copies that are owned by people in this room. I'm one of them. And if there's somebody who shouldn't be pessimistic, it's him, because he sold 35 million copies of this book. It's the best-selling financial book of all time. So you shouldn't be a pessimist if you've managed to achieve that. And yet, in his old age, he's very bearish about everything. And a couple of years ago, he came up with a tweet where he basically said, sell all your financial assets and buy tuna. Now, I'm not sure that was a great call. If you listened to him 2 years ago, you've got two things I would suggest today. One is it's very expensive tuna, because the opportunity cost that you've forgone in the process has made sure of that. And secondly, I would also suggest you check that expiry date. This brings me to the Wolf of Dorp Street and the concept of meeting management. Now, I'm showing you two columns of mine that were published 2 weeks apart in the Financial Mail. The one on the left-hand side was published the week that I presented this the first time in Cape Town and Johannesburg at the beginning of March. And Marcus Jooste, of course, was alive at that point in time. The physical copy of that Financial Mail was still on the shelves at P&A, and I don't know what the other shops are in Hermanus, that Friday afternoon, a week later, when Marcus Jooste walked down the cliff path, and you know what happened after that. So the timing is a little bit eerie, I have to admit, for somebody who showed some of these slides and just spoke briefly about the topic I'm going to address on the next slide. And then a week later, of course, I wrote my follow-up. So these were 2 weeks apart. I just thought I'd frame it like that, and to reassert what I said right at the beginning. And the only slide that I showed at the time, it's the same slide that I'm showing today, is this one, which is an extract from the Financial Mail in December 2017, the week after the Steinhoff bubble burst. And there's a quote there from Shane Watkins, who a number of people in the room will know, from All Weather Capital. And Shane commented by saying that he thought he would guess that about 80% of fund managers believed Marcus's stories, and about 20% were the ones who were a bit more cynical. And I think those numbers are about right. I also met Marcus a few times. Evan is in the room here with me. You'll see him in action later, from 361. We were colleagues at the time. We were in the same room when Marcus came to our offices back in 2009, I think it was, and explained all sorts of things. And you could never pin him down. He always looked you in the eye. He always smiled. He always had an answer. He was extremely charismatic, and he was extremely believable. And I would argue that's exactly why he got away with what he did for so long. And my message ultimately is not about Marcus and Steinhoff anymore. It's about the danger of meeting management in general. Koki Koeman is a good friend of mine. He loves flying around the world to meet management. We've had this conversation for 30 years. I don't. I say to him, ignore management, because at some point they're going to deceive you. Rather, just look at the numbers. A good manager is not a charismatic personality. A good manager is somebody who can show a track record of delivery. That's all it is. And you don't need to meet them in order, to judge that. We can chat more about that, separately. I wish you could see a bit more detail here, but this is the CFO survey from Duke University. So for the last 23 years, Duke University, in conjunction with one or two other partners, asks CFOs in America on a quarterly basis 2 questions. In fact, they ask more, but I'm focusing on 2. One is, how optimistic are you about the prospects for your own business? And then, forget about your own business. How optimistic are you about the overall economy? Everything else you see out there. Now, if you think about this, There's more than 2,000 data points on here, 2,100 I think is the number. It's all across America. So if you ask 2,100 CFOs across America about prospects for their own company, and you average that, you should come up with prospects for the economy, because the one approximates the other. The one adds up to being the other. And therefore, these two lines, if you ask them for a score out of 100, with 100 being very optimistic and 0 being totally pessimistic, if you ask them for a score of 100 for both, those two lines should basically run on top of each other over time, with a little bit of variation perhaps and volatility, but they don't. The red line, which totally dominates the blue line, is the prospects for my own company. And the blue line is the prospects for the whole economy, which just says that people are not only optimistic, they are over-optimistic. They overemphasize their own prospects compared to what's ultimately out there, realistic. This is the financial equivalent of me asking you guys, who in this room believes they're an above-average driver? And 2/3 of you put up your hands, okay? Which is very possibly going to happen. Mathematically not possible, but that's human nature. Okay? There's only one observation in 23 years where it swung the other way, where people were more optimistic about the economy than about their own company. So over-optimism. So I'm telling you, don't meet management, because you're going to suffer from their over-optimism. You're going to listen to their over-optimism. And you'll have to sort of turn on your over-optimism filter, also known as your bullshit factor, if you're going to listen to them. I'm now going to talk about the management, that if you are optimistic enough, and if you are charismatic enough, and perhaps successful enough for long enough, you can maybe make it onto the Forbes front cover. So in June 2014, we saw Elizabeth Holmes, who started Theranos when she was 19. 10 years later, she made it onto the front cover of Forbes. Less than a year later, the Wall Street Journal reveals that the whole company is a fraud. She went to jail, and she's going to sit for another 10 years. Adam Newman started WeWork and ran it for the first 9 years of his life. Now, at a high point, it was valued at $40 billion. Today, it's worth 0. Some premises left, but the company is bankrupt. Adam Newman avoided jail, and in fact, he walked away from the company. He was sued by his co-shareholders for a breach of fiduciary duty. He managed to walk away. You don't feel too sorry for him. He's still worth more than $2 billion. Chengpeng Zhou started Binance in 2017. Fast forward to a couple of years ago, when he had charges of money laundering leveled against him in the US. He paid a small fee of $50 million as a non-admission of guilt fine, and is now hanging around with the Guptas in Dubai. Now, I can tell you, if you read in the newspaper that I pay even $1 million for a non-admission of guilt fine, I'm probably guilty. Okay, I'm not sure where I'm going to find the $1 million, but I always find that kind of language quite interesting. And then finally, Sam Bankman-Fried, responsible at the tender age of like 32 for the biggest financial fraud of all time, bigger than Bernie Madoff. This has been in the news a lot in the last year. I don't need to tell you too much of that. He was found guilty at the end of last year, and eventually sentenced in March this year, and he's going to spend another 25 years in the Chuki. It was Michael Lewis who interviewed Sam Bankman-Fried when he was still on the rise. Now, I'm sure you are all Michael Lewis fans. We all are. He's a wonderful writer. And just like I maybe wish that I never met Marcus Jooste, I think Michael Lewis probably wishes that he never met Sam Bankman-Fried, because he totally believed the guy. He wrote a book where he basically lauded him from page 1 to page 300. He still doesn't believe that Bankman-Fried is guilty. And there's a quote there where he told Brad Katsuyama, who introduced them to each other, say, do whatever SBF wants you to do. What could possibly go wrong? That is how that first chapter in the book ends. There's one more slide about Forbes. This is Forbes in Russia, April 2004. Now, ladies and gentlemen, I don't read Russian, but I suspect it says that this is not a very good manager either. I hope you can read that font. I know there are some cricket lovers in the room. I shook hands with one of them just as I came in. I'm sure most people remember Hansie Cronje, and we remember that Hansie was a very exemplary personality up to a point in time. On this picture, he wears that "What Would Jesus Do" armband. I actually wrote a book about this. This is not about me punting my book, because it's not available. If you're really desperate for a copy of the book, speak to the author. He's got a few free ones to give away. So I'm not punting my book. But I'm just going to summarize by saying, for this whole section, and I think Hansie also sort of typifies that, the best con artists in the world end up being the best con artists in the world because they are so believable. It was true for Hansie, it was true for Marcus, it was true for those 4 people on the front cover of Forbes. Just watch out when you meet management next. And my question to you is, what if the CEO is a druggie and he goes on the Joe Rogan show and smokes dope on live television? And my answer is, it doesn't really matter what they do in their free time or when they go on TV. What matters, and I said this before, is simply one thing, and that is a track record of delivery. It was Warren Buffett who said, that you should invest in a business that even a fool could run, because one day a fool will. And then finally, ladies and gentlemen, my last topic, which is that the world has too much debt and America's got too much debt. A lot of you will probably know, and you've probably seen the debt clock in America, which went up in the 1980s, just around the corner from Times Square. And if you look at the debt clock, it runs up by the second as the American debt keeps on growing over time. So this thing has been, around Times Square for something like 50 years. It looks different today. I took this picture myself about 2 years ago. It's moved around the corner into an arcade. When I was there in October, just about 2 years ago, the US debt was at $31 trillion. It's now at about $35 trillion. But you can go, when you go next time, look for it and go and take your own picture. You don't need to go to New York to get this number. You can also go into your smartphone if you can interrupt, your surfing and checking emails. Go to a website called usdebtclock.org. It's the title on the slide there, which, sorry, you can't read it. But if you go to this website, there's a virtual version of this debt clock where all the numbers tick up. And you've got the US debt, the main one on the top left. When I updated this a few weeks ago, it was at 35.1 trillion. And then the second block there, they divide the 35 trillion by the number of US citizens, and they come up with a number of $104,000 of debt per American. Which means that if a baby gets born in Manhattan today, that poor child owes $104,000. You don't want to be born in Manhattan today. Okay. Now, ladies and gentlemen, I'm just a simple accountant, and I was taught for every debit there must be a credit. In fact, it's the only thing I remember from accountancy. I hope it's still true, 40 years later. And when people talk about there being too much debt, just ask them what assets are represented by that. What's on the other side of the balance sheet? And fortunately, this debt clock does capture that number. You'll have to take my word for it. But the US assets per citizen is the small number of $624,000 per citizen. So maybe it's not so bad to be born in Manhattan after all. That's a very solvent baby. Debt of 100, assets of 600. But you very seldom hear about the 600. This is why I refer to The Godfather, and specifically the opening line in The Godfather, where Amerigo Bonacera says that I believe in America because America has made my fortune. Now that's true for Amerigo Bonacera, and it's true for me, and it's true for you, and it's true for your clients, on the assumption that you've had global equity exposure over the last few years. I don't need to remind you that the Magnificent Seven are all American companies. And I've got no idea what the next few years holds with AI and everything else that's happening around the world. But my guess would be, I don't do forecasting, my guess would be that the next 7 names that's going to perform equally well will probably all be American. I doubt they'll come out of London or Stockholm or Berlin. If you don't know what that stands for, it means that I need to finish fairly soon, which is what I promised to do. So, ladies and gentlemen, please take academic approaches to finance with a pinch of salt because of the underlying assumptions. Do not believe any forecaster who suggests that they've got a crystal ball. Always bear in mind that the biggest risks in the world are ones that you cannot forecast. Meet management if you like, but beware the wolf of Dorp Street. Don't believe the hype that the world has got too much debt. And finally, please don't sell your assets and buy cans of tuna fish. What you should rather do is you can give it a credo. For CPD purposes, I was allowed one marketing slide. This is my one marketing slide in full detail, as you can tell there. We have a global equity fund and a feeder version of it, which is on the BCI platform. We've had a nice run recently. 18 months ago, we got a raging bull for that. Then last year was a bit of a tough year, and the last 6 months have been pretty good again. It's all a question of style. We are value-based managers. We can have that conversation another day. You'll be very happy that you can't read that font because it's a friendly message from my compliance department. I will translate it for you. It basically says that he doesn't know what he's talking about, but thank God he's finished. Thank you.
Dion, thank you so much for that evidence of a true top quality presenter and fund manager. You can throw everything at Dion and he remains perfectly focused. Dion, thank you very much for that. We are going to do a quick system reset. That's why everything is going up and down. So give us about 32 seconds to 1 minute before we continue. I normally tell my daughters as well, life is life. Sometimes things just happen. But character speaks to, how you handle problems and things that comes your way. So again, Dion, thank you so much. It was really a good presentation. Our next session on local equity, and thank you for your patience. Everything, or mostly everything, seems to be working right now. At the May conference, we spoke a lot about SA equity and the anticipation and the outcome of the elections to see where it's going to go. It obviously went a lot better than I think we could have hoped for. And there is glimmers of hope in our economic recovery. And market seems to do extremely well. We advocated for higher allocations to SA equity, and it worked well. But a lot of clients are asking now, was this, did we see the final run? Was it just from oversold positions back to levels where it is now? Or is there more to come in SA equity? And we're going to focus a lot on that. And our panel for the morning on SA equity, we're going to start with Charles Gous from Bateleur Capital. Charles will be followed by Evan Walker from 361 Asset Management, and Evan will be followed by Nick de Vos from Centaur Asset Management. Charles, thank you so much for being here this morning. Really appreciate your time. Thank you.
Is it down again?
Organised chaos there.
Thank you. All right, seems to be working. Good morning, ladies and gentlemen. I'm Charles Gous from Bateleur Capital. Today I would like to tell you a bit about the business as well as the Bateleur BCI SA Equity Fund. So we'll have a particular slant towards SA Equity. We did want to do some forecasts today, but we'll call it guesses given Dion's presentation. But the good news is we'll at least be optimistic and not pessimistic. So let's get going. Bateleur Capital was founded as a hedge fund management business in 2004. Our first fund was launched in 2005, so the business and the funds that we manage have got longevity. We've got a focus on equity capital preservation products, where we apply a consistent investment process across all the equity mandates that we managed. And we're not particularly focused on a specific investment style, and have got a flexible approach towards capital selection. The business is independent and 100% owner-managed, with all key individuals, shareholders, and active in the daily running of the business. Lastly, we're not a large fund manager by size, so our relative AUM gives us an opportunity to participate across the vast spectrum of the JSE. It's fair to say, leading up to the national election, there was a lot of pessimism in the market, and it was not uncommon to see negative news articles like this questioning whether we've hit rock bottom in South Africa. Similarly, when we interacted with fund managers and investors, we continuously highlighted the attractive valuations available on the JSE, in particular for high-quality companies. Today, we add a glimmer of optimism to that title, and it's because we've continuously received pushback when we presented the attractive valuations, and the general view was, so what? What's going to change? What is going to result in a better investment environment in South Africa? And we'll try and address that in today's presentation. I think as a starting point, we still consider South African risk assets as undervalued and very much under-owned, and we'll show you some slides on that. But there's some positive signs emerging. The first one, and I do think we need to celebrate, is Eskom, and we've now gone in excess of 160 days without load shedding. And a lot of speakers will talk about this today, but I do think we need to celebrate it. It was a significant drag on economic activity in 2023. Transnet is stabilizing and receiving a lot of attention, and we'll discuss that, as well as a recent Nedbank capital expenditure report that points to a sharp increase in investment in the country. And very importantly, we're starting off a very low base. That's positive for equity returns. Business and consumer confidence is low, economic activity is low, and very importantly, interest rates are very high, and our real rates some of the highest that the world has seen. I won't make this a political presentation, but I think it's fair to say that the GNU was the best possible outcome we could have received if we dial back the clock a couple of months. And now it's really up to execution, and obviously all of these parties remaining in a cohesive engagement. So let's get into the meat of it. In this slide, we have a look at sentiment and positioning of South African equities. You'll see that foreign investors have been continued sellers of equities in South Africa, and we highlight two key areas. 2018, with the appointment of President Cyril Ramaphosa, we've seen a small increase in foreign interest in SA equities, and post the formation of the GNU, there's been very limited interest from foreign investors. So that's a positive base effect. As an example, next week there's an R&B conference, the Big Five conference, where about 50 or 60 corporates and various keynote speakers will be active. Over the last 4 years, there's been no foreigners at this presentation. Next week, they expect up to 400 foreign investors to come to Cape Town to attend. So very positive, and some interest definitely starting up. We've seen a similar trend in South Africa. Local fund managers are very much underweight South African equities. This estimate puts it at 37% exposure, the lowest in many years. And to put in perspective, the chart on the right, I'll draw your attention to the red line. That's the valuations of the SA banking sector. Even though we've seen a small increase in the share prices over the last couple of months, it's still immaterial relative to where the valuations have traded over the last decade. So valuations remain very attractive, and there's very little interest in the South African market still at this stage. At Batelier, we constructed a hypothetical path to structural growth for South Africa. In doing so, we're trying to answer the so what has changed, what can change question. And I stress it's a hypothetical scenario at this stage, but 6 or 12 months ago, we wouldn't have dared to put up a slide like this to discuss a potential scenario where growth can accelerate in South Africa. So this is where the guessing part starts. In any case, it starts with structural reform. Structural reform ultimately leads to confidence, business and consumer confidence. Confidence leads to investment. Investment leads to job creation, and job creation leads to credit extension, where newly employed people and businesses require credit and benefit from the flywheel effect of credit extension. So as this sort of circle starts gathering pace, there is a chance that we can move to structural growth in South Africa. And again, I'll stress, this is not our base case. Our base case for the next couple of years is a cyclical uplift in GDP growth and not a structural change at this stage. But there is work being done in the backgrounds that is pointing to a more positive environment. The most obvious example of structural reform to date has been Eskom. And again, I won't labor the point, but in July, Eskom now told us they've got too much electricity. The next area that requires attention is Transnet. In the chart, you'll see that our iron ore exports are tracking better than last year, but we're still below the previous year. Our interactions with Rudy Dix, that heads up Project Vulindlula, points to significant interest and attention being given at Transnet, not just from a government point of view, but the mines are involved as well. And that will be another 12 to 24 months before we see a material improvement at the performance at Transnet. And that's not the most difficult thing to do. I mean, they're following the Eskom playbook. Get the right legislation in place, semi-privatize, and get business involved to improve the processes. So we expect a material improvement there in the period ahead. And obviously, as these reforms materialize and we get more evidence of structural reform, consumer confidence and business confidence increase. And there's some early evidence of that too. Johnny Copland from HCI talks about phone calls being returns and things that's getting done, and how he's optimistic about the future. Similarly, Graham Dunford from Udeco talks about how fixed investment in the country has got the potential to be a needle mover for South African-facing companies. Why is this important? If you look at the two charts, confidence is directly related to consumer spend and investment spend from businesses. It's quite simple. The more confident people are, the easier they spend. The more confident CEOs or business leaders are, the more easy they will access or action a new project. Increased confidence, in turn, will lead to investment, both public and private. And here too, there's some early signs that we can have a look at. Firstly, Dean McPherson talks about turning the country into a massive construction site. Now, obviously, he's a politician, so let's look at the facts. Nedbank produces a biannual report where they summarize all the announced capital projects in the country over a given period. For the first half of this year, projects to the value of 794 billion rand was announced, relative to 194 billion rand last year. And I'll remind you that the first 6 months of this year was certainly clouded by a lot of pessimism. So very positive from a capital investment point of view. If you look at the chart on the left-hand side, you'll see how that 794 billion rand dwarfs anything we've seen since 2008. And you have to go back to the Soccer World Cup period to see more activity in the country. So very positive for investment in the country. A lot of that is focused on energy and renewable energy. And we expect more positive signs out of that in the coming period as spend increases at Transnet, Eskom distribution, and obviously there's a huge backlog in water that needs to be addressed as well. So increased investment for a country like South Africa is obviously a very easy way to accelerate employment. Investec estimates that if we just bump up from 1 to 2.5% GDP growth over the next decade, which is a scenario that could be potentially favorable for South Africa, will add up to 2.1 million jobs. All else being equal, that reduces the unemployment rate by more than 10%. So a big impact on that side. Also, what I found interesting is if we look at the unemployment numbers per province, thankfully we're in the Western Cape today, and you can see the Western Cape unemployment rate at 21%, which is a clear indication of what can be achieved in a province where you've got pro-growth and investment policy. So hopefully some of that with the GNU filters into some of the adjacent provinces. So increased employment and wage growth will increase credit extension, both private and business. And the important thing about that is that credit's got a big multiplier impact on GDP growth as it accelerates demand or pulls demand forward. This quote from the IMF just confirms that relationship, how growth and credit extension plays hand in hand. And what I do think is important, if you look at the chart on the bottom left, is that credit extension averaged 14% per year from the 1970s to the early 2010s. And you'll see over the last decade, credit extension pretty much averaged 5%. So our banks have been extremely conservative, and it's because they lacked confidence. They lacked confidence to lend into a weak economy. They built up capital, as you can see on the chart on the right-hand side. If you look at that blue line, banks have built up capital and actually have got too much capital now. That's why they're paying very healthy dividends at high payout ratios. And the good news is that the financial system has got a lot of capacity to extend credit and accelerate GDP growth. Some estimates point to the big banks having the ability to extend up to 500 billion rands of additional credit into the economy. So obviously, a lot of forward-looking stuff here, and it's very important, given past disappointments, South Africa remains a show-me story. But as I said at the start, we haven't been able to sort of envisage this more positive scenario for quite some time. And there are early signs that growth opportunities in South Africa is most definitely improving. This is also echoed by some renowned research houses. We haven't seen big banks and institutions like the BER come out with accelerating GDP growth numbers for quite some time. Standard Bank now points to about 1.8% growth for next year and above 2% from 2026. And similarly, the BER has put out a report with a sketched a scenario where we could potentially get to a 3.5% GDP growth rate by 2029. And if you look at the chart, if you can see it there at the bottom, the BER highlights similar driving factors that as we've discussed today, being structural reform, consumption, and credit extension and investment. So as key drivers to get economic growth up into a more acceptable level. So how are we positioned in this environment? The Bateleur BCI SA Equity Fund is overweight SA equities, but bearing in mind we still carry a substantial amount of rand hedge exposure in the portfolio. Within the SA-facing companies, we favor higher quality companies. We think these businesses will attract a significant premium in a more favorable investment environment. And should the opportunity not play out as we envisage, we think these companies will outperform their counterparts and continue to gain market share as they are best in class. There's special opportunities, like deep value opportunities in the likes of Remgro, trading at a 45% discount to net asset value. And again, given our size, we can access a quality mid-cap basket, which we view as a clear differentiator relative to large asset managers. Within the resource side, the companies that we've included are not based purely on their rand hedge characteristics, but on their investment case and growth opportunities that we've identified. So if you look at the chart on the right-hand side, you'll see that the Bateleur BCI SA Equity Fund has had 3 strong years of absolute and relative gains. We continue to run a concentrated portfolio of 30 or less stocks. We've got a deep understanding of the local SA equity market, and we continue to find very attractive opportunities to deploy capital. Thank you very much.
Morning, everyone. Nice to see you all again. After Deon Gouw's presentation, I almost feel I have to justify my existence. So we're going to try really hard to do that going forward. 361, very briefly, guys. 50 billion AUM, 20-year-old business, pretty good performance, in fact, very good performance. But again, what do we do? What do we look at? I think there's 3 very, very important things. I mean, the only 3 things that I really focus on, okay, in the investment climate, I don't really focus on finance, because finance is a consequence of what businesses are doing, okay? 3 very important things. Supply and demand, okay? Single-handedly the most important thing, okay, around the world, for any manager, for any company, supply and demand. In fact, if I had to ask you guys, which is one of the best asset classes in the world over the last 2 years, I don't think any of you could get it right, okay? You've probably been eating too much of it, okay? And that is cocoa, making chocolate, up 200%. So, and that's all not a demand factor, supply factor. But supply and demand, guys, are single-handedly the most important thing you need to look at. The second most important thing, okay, and this is all economics, despite the can opener, the second most important thing is who's the marginal buyer. So at the margin, who is the marginal buyer of the product and service? Who is buying, okay, more chocolate, or who is supplying more chocolate and cocoa, all right? Who is buying more cars? Who's supplying the palladium, which is down 60%? So the second most important thing investing, okay, is who's the marginal buyer. And then the third most important thing investing, guys, and the third most important thing we look for is that giving any relative pricing power? Okay, are companies deriving any relative pricing power out of that supply and demand factor, the marginal buyer, okay, and what is it doing to their margin? Guys, finance actually, although we all pretend to be finance experts, is actually irrelevant if you can answer those 3 questions in buying a share. And that's what we try to do every day at 361. We try to answer those questions, and we try to find you opportunities around the world in an equity fund which fit those criteria. So that's ended up in pretty good performance, beating the market quite substantially in all our portfolios over all the years, okay? And I don't feel as guilty as Deon Gouw left me a couple of minutes ago. So that's what we do as fund managers. We try to beat the market, we try to add alpha, but we try to do it in a responsible fashion, okay, based on supply and demand factors. I'm going to talk to you a bit about the equity fund today, which has got the 45 offshore. It's a good building block if you want to get to 45 for clients. Okay, we think you should get to 45 for clients because there's a big wide world out there of lots of opportunity, and we think you should utilize that. Okay, but South Africa has had a great run in the last year, and that's been fantastic for the guys that are positioned there. What's the view on the world? Oh, okay, still there, thank God. Okay, what's our view on the world? You've got to have a bit of a view on the macro. Okay, starting point is you've got to have a bit of a view on the macro, okay, and a bit of the view on the cyclicality of the macro, okay, before you can look at the structural. Okay, but ultimately the structural is more important. Ultimately the structure is more important. What are we seeing around the world? Okay, and I'm very constructive still on equities, guys. Very constructive on equities, okay, for the next couple of years, because what are we seeing? A starting point is the developed markets at full employment. We've never gone into a cycle, a down inflationary cycle at full employment. The delta is going to be big, guys, okay? Developed markets virtually at full employment. Slight uptick in unemployment, okay, of late. Okay, market's been a big fixated on it. Going into recession. We're not going near recession, guys. GDP is still at 2.8% in the US. We might up in the end of the year 2.5. Okay, that's not a train smash. We're not going into recession, and the starting point in an inflationary reducing environment, okay, which we know we're in. We don't know how fast rates are coming down, but we know we're in that environment is, okay, we're at full employment. So that's a good starting point for me, okay? And two other cyclical issues is that we have China exporting deflation, bringing inflation down around the world, okay? Prices of goods are coming down from China as they have too much capacity. And the second issue I'm talking about is the amount of gas around the world and even the amount of oil. Okay, to me, not sure if it's cyclical or structural yet. Gas is definitely structural. Okay, we have a surplus of gas. We have more gas coming to market. And it's a very, very big component of industrial production around the world. 42% of energy, okay, in the US comes from gas in industrial production. 37% in the Eurozone. 15 to 20% in China. It's a big number in industrial production energy, and it's coming down fast, okay, as specifically the US and the UAE components produce much more gas and supplying the world with LNG, etc. So a big component. That to me, I'm not 100% clear if it's cyclical yet or structural. It's starting to look very, very structural in terms of the amount of energy that's coming to the world over the next couple of years, which is an important thing to grasp. Then, guys, what is structural? Structural is obviously now, okay, this re-energizing the world. This energy transition, guys, is structural and it's here for the next 30 years, okay? And it's a huge component of growth. Every single company we read, every single financial statements we read, okay, has something about the energy transition, where the companies are changing their air conditioning, okay, where they're relaying stuff, where they're already putting in new things. Every single company is having to move to a greener future. That is structural. But underneath that, it's creating a CapEx cycle, which we only think is just beginning. Decarbonization follows on from that as we move to EVs, charging stations. We see China already has laid down, hundreds and hundreds of thousands of charging stations. They're 70%. Okay, of the world's charging stations are now in one country, China, and they're moving rapidly in terms of decarbonizing their environment. What's come on top of that has been this big growth element of AI, okay, with all the semiconductors, okay, and the energy now to supply that. AI alone, okay, has taken energy demand over the last 10 years, and AI has always been around in some form, up tenfold just the requirement from, obviously, all these big data centers, the requirement, and that's going to do tenfold again from the starting point now, and it has to come from renewables. Because the governments aren't allowing it to do. Then lastly, which is still structural, is this onshoring as companies have moved closer to their home destinations. Technology has allowed companies to get closer to home, bring things closer to home. Okay, and we're still seeing a huge element of that around the world as companies bring industry back. A great example was Caterpillar. I went to a conference last year overseas. Every single economist said we're going into recession, yet US companies were pumping. Caterpillar's numbers in the US last year, US alone was up 25%. They followed on again this year with another 20% off a base of 15. Guys, massively strong growth in the big domestic economy based on these, which I think are still very structural around the world. So we can see CapEx cycles are turning up. We're just at the start, guys. CapEx cycles are turning up, okay, as everyone has to reconfigure this global environment, and that's not going to stop tomorrow. And it's a great underpin for GDP growth. We've got the cyclical underpin coming now, obviously, with rates, and that is the big one. That's why everyone's so fixated on it. But we have a massive structural underpin, okay, as the world changes. Below that, we're looking for demand factors, okay. We're not just purely invested in AI, purely invested in data centers, purely invested in copper. We're not just purely invested there on those structural factors. We're looking for demand factors and other factors below that. We're not going to get all this capex without finance, so you've got to have banking, okay? There's a big defense spend around the world, which is coming with a whole lot of drivers of its own. Global travel, guys, okay? We have India coming online, okay? We still have China coming online with millions and millions of additional travelers. There's a marginal buyer coming to the market still in this travel sector. It is a bit cyclical, but to me, it's got a lot more structural components. Health and wellness, very structural, guys. We've seen the advent of these new weight loss drugs. Novo Nordisk just published yesterday or the day before. Now have a tablet. Stock's up another 5. We've owned it. We think it'll still do well. But the innovation, okay, around the sector is still going to be very exciting. And then lastly, guys, from a demand factor, people are going to demand yield. Okay, simplistically, they're going to demand yield. Okay, so we've owned a lot of property in the portfolios. In fact, at one stage, we almost looked like a property index portfolio. Guys, just very briefly, I've got to move time. GDP holding up despite Fed funds rate. Holding up way better than we thought, and this is just the starting point. Okay, so, if you told me rates were going up 500 basis points and GDP would be 3% 2 years ago, everyone would have said you're mad. But everyone forgot to look at those structural elements of growth around the world. Unemployment. Okay, by now we thought we would have been at 7s or 8s. Okay, the unemployment rate, and we're just above 4s. So guys, not a bad starting point from a cyclical point of view. And what do markets do? Into rate declining environments, anything between 20 and 40. We've had a good start. S&P up 16%. We think it'll still go a lot higher from here. The big bugbear around the world is China, and China's not an easy one, okay? China GDP, I think, will be lucky to do sort of north of 3s this year. Energy growth still strong in China, transitioning still strong, EV still strong, domestic economy in certain sectors still very strong, but we know construction, okay, housing specifically and infrastructure coming down fast. Second quarter infrastructure numbers on a forward order book are down 23%. We don't like miners, guys. We don't like diversifiers. We like copper. We can buy copper, pure play coppers in the US through Freeport, etc. But we don't like domestically our mining sector currently at this point of the cycle. We're staying away. And we're staying away from China per se, okay, just because we're nervous, the economic footprint, specifically in resources. Guys, and lastly, this sums up South Africa. South Africa over the last 20 years has favored consumption over investment. Okay, until we got to rock bottom, guys, until we got to rock bottom. Okay, and now we have to spend on investment. It's going to cost us, it's going to cost all of us, okay? But we have to spend on investment, and we want to follow that demand factor as more companies come in, more renewables come in, okay, and we fix up, hopefully, this country over the next couple of years from demand factors, okay, which is hopefully going to breach that slant. Charles put this up. Nedbank's forwards capex order books looking very strong. A lot of this is renewables. A lot of this is obviously a cause that came through Eskom side, but we're going to see a lot more of this coming as private sector, not so much government, as private sector, okay, comes in and sorts out the mess. So I've been asked to talk what we like and don't like. What we don't like in South Africa, we don't like diversified miners, we don't like telcos. They crap businesses, too much capex. PGMs we hate, we've been long short. Demand factors, we looked at that market very well. We made 10 times our money on Impala as demand went up. As EVs came, demand fell off. We actually sold and went short. And Sasol we're indifferent on. We just don't think there's an energy cycle coming, okay, from a demand side. What we own, what we don't own currently, but what we have owned, we've owned some insurers, we've sold out at higher valuations, we've owned retailers, we still own ShopRite. Industrials, we've owned Bidvest and sold it out on higher valuations. Good business, we still own Bidcorp. Luxury, we don't own, we don't like China. And lastly, tobacco, we don't own, we don't like the dynamics. So what do we own in South Africa? We own a big slug of this banks. Okay, Dion said earlier, in the top 15 or whatever, we've got a lot of banks. We've got a lot of banks, guys. They're cheap, well capitalized. They're going to enjoy the growth. They're diversified across Africa and the UK. All right, and we hope to see, okay, a lot of new activity in this banking space, and we're seeing it already, and we own a lot of banks. We don't have to go offshore to own gold, okay, because we can own good gold companies in South Africa, and we can own you good property shares. So I own a little bit of offshore property, okay, but not a lot, okay? We own a lot of property. And then within that, we own some good companies, okay, good companies that are going to benefit, okay, from this CapEx cycle, like a Roynet, okay, which is going to do a lot of the new distribution for Eskom, okay, and see the benefits, and it's got a great defense business, and it's a nice small business which we can own in a business like 361. That's the geographic split of the funds, 35 still in SA, but then the rest from an offshore perspective around the world to give you that diversification, which I think you need in a portfolio for your clients. So lastly, guys, this just includes the offshore. Okay, I've got 24 seconds to go. I'm doing pretty well, Eugene. Technology around 20% of the fund, financials around 20, resources mainly gold, property close to 10 now. We own some indices, guys. Why do we own indices? We own indices for a little bit of cyclicality in the US market. We can pick it up through indices. And a great indice, everyone always asks me, what can they buy? Great index, I think you can buy with very little risk, okay? Might not shoot the lights out, but it's going to do well. It's called the RSP. It's the equally weighted S&P. It strips out the Magnificent Seven, okay? And it uplifts everything else in the economy. So it's a little bit of a cyclical punt on the US market, but it's way cheaper than the S&P, okay? And it takes out that Magnificent Seven risk, okay, in the market. So it's called the RSP, guys. Add a little bit of that to your portfolios, okay? And you can throw things at me next year when we're here. And then lastly, guys, we've spoken about the bid corps, South Africa, the decarbonization theme we're adding to all the time, mostly with global businesses like Schneider Electrical, Freeport, Prisimian, all the guys supplying into that decarbonization theme. Travel and luxury, we continue to add to hotel groups. Healthcare, we've added Novo Nordisk and AstraZeneca offshore. Retailers, ShopRite, and a big punt on JD Sports now in London. Up to 2% of the portfolio of recent. Mobility, semiconductors a little bit, and then lastly, cash and bonds. And that's my time up, guys. So a well-diversified portfolio, trying to follow all those big global themes, guys. Trying to follow the demand factors, which we think are important, okay? We don't bet too much on cyclicality. It's about 10 to 15% of the portfolio bet on cyclicality. The other 85% bet on structural improvement, hopefully coming. Thank you so much.
This is Mike, yeah, great. Morning, everyone. I'm Nick DeVos from Central Asset Management. Wait, am I going the wrong way? Sorry. Usually I'm on the multi-asset panel. It's the first time I'm on an SA equity panel. Just briefly, for those of you that don't know, I'm sure a lot of you do, Central was founded in 2000, so the business is almost 24 years old now. Very simple business. Up until November last year, we only had two funds. So it's the flexible fund that launched in 2004. It's number one fund in its category over 10 years. And then the balance fund that launched in 2013. It's got a track record over 10 years now. And number four in its category over 10 years. And both the one-year performances of the funds have been quite good. Then, towards the end of last year, we decided to launch an SA equity fund, and that's really what I'm going to talk about today. Similar views to what Charles mentioned earlier, so I'm not going to go through all of it in too much detail. But this is just the fund and how it's performed to date. Up until August, it's been running for 10 months, done just over 19% return. So managed to catch that post GNU rally in the market. The fund's just over 600 million in AUM at the moment. I think that still gives us quite a good opportunity to take advantage of some of the smaller mid-cap stocks that are out there that the larger guys can't necessarily buy. I'll show a few of those to you in the last slide. And then over here, I just want to show you that SA equity is essentially the core of what Centaur's been doing for the past 24 years. If you go and look at the flexible fund, and you really go and strip out where all the alphas come from, it's essentially come from SA equities. So this is if you strip out that SA equity component from the flexible fund, because the SA equity fund we've launched doesn't have a long track record, over the past 5 years, this is on a gross of fee basis, but managed to outperform by 6% per annum. Just in terms of SA, in quite a simple slide here, and this goes towards the interest rate cycle. But post the GNU, everyone's talking about all this positivity, and you would have thought the rand might be a hell of a lot stronger where it is at the moment. So we're sitting just under 18 rand to the dollar. Why not 15 rand or stronger? But over the past 12 months, the rand has performed exceptionally well on a relative basis versus other currencies. So if you look all the way on the left-hand side, Brazil, Mexico, 10%, 9% weaker relative to the dollar. Rand 6% stronger, and also compared to some of the developed market currencies like the euro and the pound, where the rand's performed relatively better. And why this is so important is because the SARB's so fixated on what the currency does, and this gives them space to cut rates. Along with this, oil prices also coming off, and I think this is quite consensus now that end of this month we should get about a 25 basis point rate cut from the SARB. In terms of historical growth, December 2013, 2018, not great growth, 1.2% per annum from South Africa. The years after that, 0.4%, so essentially no growth. So we're saying the next couple of years, maybe South Africa grows by 1.75%, which surprisingly is actually on the lower end of what a lot of guys are starting to say. A lot of people are starting to say, SA might grow at 2% plus. And a big reason for this is that we've been very disappointed in the past. So we've kind of like seen this story before. So we're saying things are going to get better. We're coming off of a very low base, but maybe we won't see, like 3% type of plus numbers that we actually do need to see. But still, 1.75% is not a bad number. And then on the right-hand side, I've just highlighted a couple of very positive points that are coming across. Maybe the one I'll just mention, the two-pot retirement system. Some of the estimates that have been going around is that 50 billion rand could potentially be withdrawn. It adds about 0.5% of GDP. Some of you might have seen this, but Alexander Forbes in the first week has already seen, I think it's 1.5 billion rand. They're about 10% of the pension fund market, so running significantly ahead of, I think, anyone's estimates. Some of the businesses' systems essentially have crashed, given the amount of withdrawals that they're receiving. And that money is going to most likely going to find its way into consumption. So I looked at the slide this morning and I thought, why the hell did I put this thing up? It's complicated, so let me just simplify it. So if you look at the grey bars, that's all you need to look at. So this is SA's percentile performance of GDP relative to other countries. So in that period, 2004, 2012, we were about in the kind of like 40% range relative to other countries' GDPs that the IMF tracks. Now, if we input our expectation at 1.75, and I just mentioned that that's probably on the lower end, you get a scenario where you start seeing that blue kind of bar uplift relative to what current expectations from the IMF is. I think this is quite important. If you're a foreign investor, the reason you go into emerging markets is for growth. So, foreign guys looking at South Africa haven't seen growth for many years, and relative to other countries, we're also not growing. So if we can go back to this period that we had in 2004, 2012, foreigners might start getting interested in the country. Charles mentioned earlier the Big Five conference that's happening next week. Typically we apply for 30, 35 meetings, and they've actually started rejecting our meetings because they're making space for all the foreigners that are coming to the conference. Then this chart here just illustrates the weighting of SA within the MSCI Emerging Markets Index. And you can see in the good years we were up to 10%. China came along and they've had a lot of listings, so that's been part of the reason why we've fallen further down on this. But currently we're sitting at about 3%. On the JSE, you roughly get about 20 billion rand of trade a day. If we can move up from this 3%, every 10 basis point increment on this index that we move up is around 45 billion rand of flows that could potentially come into the country. So it's easy for a foreign emerging market investor to ignore if you're 3% of the benchmark. You can ask any fund manager if something's 1-2% of the benchmark, they don't really pay much attention to it. So it's a bit like the gold names that are now 8-9% of the benchmark. Now all of a sudden you're forced to look at them. So if SA's weighting goes up here, I think a lot more foreigners are going to start becoming interested. Whether the SA run is over, we actually think the initial gains have been made. So the market's run up. We haven't seen, in anticipation of all of this, we haven't seen any companies actually put good numbers on the scoreboard yet. There essentially isn't much growth on the ground at the moment. So the market's anticipated this run-up. We've actually been trimming a little bit across the SA Inc. names. But the next leg of it is going to be when actual growth starts coming through. So if you haven't bought SA Inc., you still might get an opportunity if there's a bit of a pullback. In terms of where the valuation's sitting, that the green line is essentially kind of a proxy for SA Inc., sitting at about 9.5 times earnings, historically traded around 12 times. And South Africa actually used to trade at a premium. If you look at the kind of like yellow line there, we actually used to trade at a premium to the emerging market index for quite some time. SA used to be the darling. So I think if we can get growth up, we start moving up in the indices, that scenario could potentially play out again. I've just given here this last bullet point over here, kind of like a blue sky scenario of what SA performance could be. So if you assume a re-rating of about 8% a year, that gets to that 12 kind of times, 7% nominal growth and 4% dividend yield, then SA could potentially, this is SA Inc. shares, not the JSE, give you 20% return per annum over the next 3 years. So, guys usually show the larger cap names that they're invested in. So I thought, this is maybe a little bit different to give you kind of an idea of the smaller mid-cap names that we invested in the fund. I'm not going to go through all of them in detail, but, essentially Southern Sun, they've got a hotel portfolio. Around half their profits come from the Western Cape region. Sounds like forward bookings for kind of next tourist season are looking quite good. But Wes mentioned it on their call the other day. The replacement value of the portfolio is about 30 billion rand. Now, there's a lot of reasons why you trade at a discount to replacement value. But just for context, the market cap's about 9 billion. We think Marcel's an exceptional operator. Just to give you an idea of what an exceptional operator does. Post this GNU, it seems like the government's pulled back a little bit on spending. I think there's a bit more oversight and guys are a bit wary of going out and throwing parties at hotels. So the government travel's slowed down a bit. But as soon as he's seen this, he started pulling back on costs in the business. Now, good management typically does that, whereas other guys are oftentimes oblivious and costs run kind of like ahead of where the top line's going. PPC is one we've liked for a while. It's super geared to the interest rate cycle. Essentially, about 80% of their volumes are exposed to the retail market. So if you have rate cuts, that's going to benefit them. We've got a special dividend they declared, so we are going to get capital returns, 33 cents in the next month or two. And they've got a new management team, which we think is going to potentially turn the business around and improve margins. Stadio is a structural grower, essentially stepping into the void of the public university sector. I'm sure you all are familiar with the name. That's one that will probably hold for a number of years. Nampak, that one's done quite well for us of late. Phil Roos at the helm of the business. He's done an exceptional turnaround story, much quicker than we thought he would do it. We think earnings can grow about 30% per annum from here. And it's a function of gaining back market share and essentially just deleveraging the business as it is still quite highly geared. And then Sepaku is one that a lot of you probably haven't heard about, but that's also a cement company that's trading at 3 times free cash flow. The guy running the business, Kenneth, actually started the ready mix business within Sepaku, and we think he's an exceptional operator. So just in conclusion, so we think SA Inc. can still perform. I think there's a bit of a pause now. We need to start seeing the growth come through for the next leg. The small and mid caps, I think there is still material upside in a lot of them, especially if growth comes through. They'll almost be like supercharged to the cycle. Centaur as a business, I didn't mention this, but we just crossed 10 billion in assets under management last month. So very robust business, but I still think we're very nimble and able to outperform and trade in and out of things. And then we're quite confident that the SA Equity Fund will outperform into the future. So great, that's my story. Thank you.
Thanks, Charles, Evan, and Nick. Great insights into SA Equity, most definitely. All three fund managers has SA Equity funds. As Nick also mentioned, they recently launched the pure SA Equity fund. So if you want to bump up the SA Equity exposure, you know where to look. For our next session before tea, we're going to look at fixed income. Most certainly a lot of excitement in fixed income over the past few months. Bonds did phenomenally well. And you may think that you only want to head into nominal bonds at the moment. But are there potentially still some risks out there that can maybe derail the process? And how much of the good that we've seen is in the price already, perhaps? Our first speaker, Melanie Stockett from Laurium Capital, ready to go. Matse Mutsohani from Oregon Asset Management. And will be followed by Sydney McKinnon from Cadis Asset Management. Melanie, thank you so much for being here this morning. Great to have you. Thank you.
Super. Thank you so much. Good morning, everyone. It's so delightful to be here with you this morning. Thank you so much to BCI and this gorgeous venue. What I thought I would do, given that I'm the first of 4 speakers, is just set the scene. We've heard a lot about domestic growth potential outlook this morning from the equity guys. And I thought I'd set the scene in terms of fixed income and how we view the outlook for bond valuations if we have a slightly stronger or more optimistic growth outlook. So I call it the growth edit. But just to put things in perspective, which is tricky to do if I don't. There we go. Just to put things in perspective, I really wanted to give you the long-term view. So we talk a lot about South African growth, right? But if we look at it over a long period of time, we really get the perspective when we are hanging our heads and looking so depressed and sad about our current growth dynamics. What do we really mean? And the best way to do that is to have a look at some long-term history. So essentially, if we look back to 1994, we've shown economic growth every year from 94. As we entered into democracy, you can see that for many, many years, do you remember these days? South Africa grew like an emerging market. We had really strong growth rates between 3 to 5%. I mean, those were great times. We then had the global financial crisis. We contracted, like most countries around the world. And then since then, we rebounded a little bit thereafter, and then something went fundamentally wrong with South African growth. We've grown on average for the past 15 years, just over 1%, and for the past 10 years, the past decade, we've grown at less than 1% on average. So you might ask me then, well, is it some sort of global tide that we've been caught up in? And to answer that question, I thought I would show this chart. It's from the South African Reserve Bank. And what they've done is they've taken different types of economies and grouped them together, and they've indexed each of these different types back to 2009 and shown you what's happened to growth since then. So all indexed 2009 at 100. Emerging markets at the top, the green line, have grown from 100 to 200. So they've doubled the size of their economies over that time. Our sub-Saharan Africa peers, which is that purpley blue line, they've also grown really strongly. The yellow line shows you advanced economies. So these are big developed markets. By their very nature, they're supposed to grow slowly because they're growing off such a huge base. And then unfortunately at the bottom here, this is South Africa. We've barely eked out growth over that time. So it's very much not them. Unfortunately, it is us. Some of the spin-offs from that, from both anemic growth and poor political choices, we've seen government debt as a percentage of GDP, so the state of our balance sheet, really repaired itself as we went into democracy. We had those high growth rates, deteriorated quite significantly since then, and we've lost our coveted investment-grade global credit rating, which is what we had for many years. We've lost that over the past few years, sitting firmly in sub-investment grade territory. So that kind of sets the scene. What are the reasons why we've had some of this low growth trajectory? The first one, big pothole we've had in recent years, front and center in our minds, is obviously load shedding. You can't grow if you don't have electricity. And load shedding is so crippling for an economy for two main reasons. Firstly, obviously, it takes away from current economic output, but it also takes away from future growth because businesses aren't going to invest and expand capacity unless they have security about their energy future. And to give you some perspective, 2023, yes, was a very bad year for load shedding. The Reserve Bank has estimated that if we didn't have load shedding last year, we could have added 1.5% to our growth rate. So we grew at about 0.7. You add another 1.5 on top of that, that would have been relatively respectable. Now, just a little sidebar. So we haven't had load shedding for a couple of months. It's about 5.5 months and counting, and it's so great. We're counting in months. We're not counting in days anymore. And I just wanted to just very briefly run through some of the thoughts, when I'm thinking about this dynamic of no load shedding for now, maybe lower stages of load shedding going forward, what other positive spin-offs could there be? And essentially the first one is that it's obviously confidence, right? We all around the room, we're feeling much better about life now that we don't have to check our app every 2 seconds to see, when our next stage is. Businesses don't have to stop and start production constantly. They don't have to open and close their shops all the time. And foreign investor perceptions. I'll never forget sitting in a Zoom call with a bunch of JP Morgan traders sitting in London last year, and they all had the Eskom load shedding app on their phones. And it was so frustrating. But essentially, we could feel it as bond investors. As soon as the load shedding stage was escalated, we could feel it in the rand weakening immediately. We could feel bonds immediately kicking higher. So definitely it was that perception as well. Spoken about economic output, being able to attract investment into the economy, but we also have much lower costs to deal with. So, everyone who read the property company results during the course of last year, we had this really expensive diesel cost that most companies were carrying. We don't have that when we don't have load shedding. Other things like very expensive irrigation costs and not being able to irrigate crops within the agricultural food production chain for those elements that need cold storage. There was lots of spoilage last year. We don't have things like that anymore. So just as the Reserve Bank estimated we lost 1.5% of growth last year, they also estimated that 0.5% was added to the inflation rate. So those headwinds aren't present at the moment when we don't have load shedding. Very importantly, and I think about this a lot, is that covered over 2 decades of SA politics, and there's always been a very big ideological pushback to including the private sector as part of the solution in South Africa. And the fact that we haven't had load shedding, and a lot of it was due to the private sector coming to the table quickly and effectively, does mean that there is a rising acceptance the private sector can be part of the solution, which is really key when we think about the fact the private sector has the balance sheet and the skills necessary to sort out some of these big problematic industries. That's really important to keep in mind. And then lastly, this is a softer issue, but I think a really serious issue. It helps the political center to hold. So very early days in this idea of a GNU, and you have to admit that not having load shedding right now helps the mood music to a great extent. Right, so back to the growth potholes. The other big issue we've been dealing with is obviously in the logistics sector. So think ports and think rail. You can see just one chart I can show you is that if we look at freight transportation by rail, dropped off a cliff, that's the red line, dropped off a cliff in recent years, had to be replaced by really expensive, really ineffective road transportation. That's not a recipe for economic success. The good news is that if we have a look at Transnet, management, which is now permanently in place, definitely seem to be the right people to lead the charge. We have a plan, the Freight Logistics Roadmap, which was endorsed by Cabinet towards the end of last year in December. All of the industry experts that we speak to tell us that this is the right plan to sort the industry out over time. And then thirdly, that plan does include the private sector as part of the solution. So that's really key. So think about these two big arteries that supply oxygen to the economy. Electricity, logistics, both of those have been broken in recent years. And then if we add on top of that, we saw some charts this morning, business confidence in South Africa. This is the BER Business Confidence Survey with quite a lot of long-term history. If you print above this line, it means that more businesses are optimistic about the future than those who aren't. Right, we haven't been above this line for a very long time and been very well below. So this coincides, this entire period of being below the line coincides with this really long-term period of very slow economic growth in South Africa. And if we dig a little bit deeper into that survey, the question is asked, how many firms regard the political climate as a constraint to economic activity? And we can see, not surprisingly, that's risen consistently over previous years to the extent that almost all firms have seen the political climate as a constraint. So what does that mean? It means that businesses aren't going to engage and invest for the future if they don't know what policies are going to be like and what the political climate is going to be like in the future. This is one of the big issues that we've had for low growth, little investment spend into the economy. If we look at our fixed asset investment as a percentage of GDP, we're sitting at least 8% below the emerging market average. So it's not really a surprise that our growth has been so disappointing. All right, so that's a little bit of a history lesson. According to Dion at the beginning, he said that if you were very pessimistic, you sounded believable. So I'm sure you all believe everything that I've just told you, but let's maybe turn a little bit more optimistic about the future. Does this have to stay this way forever? What could possibly spark the engines of growth going forward? And luckily, I do have a good news story here. So Operation Vulindlela was mentioned earlier. We need structural reforms in the economy. So now what are structural reforms? They're exactly what they say they are in the tin. They're reforms that change the structure of the economy to do a couple of things: to reduce costs, to increase efficiency, to make your economy more competitive so that you can achieve high economic growth. Not even complicated. We know exactly what those reforms are, and those reforms are housed under this Operation Vulindlela, which is a joint venture between the Presidency and National Treasury, and it's really an economic reform task team. We think about them like a hit squad. They've got 5 key priorities initially. It's energy, logistics, water infrastructure, digital communications, and visa reform. So in their first phase, that's all they focused on. And what they do is they identify challenges and blockages that aren't allowing the reforms to go through, and they remove those. And they were absolutely responsible for much of the positive outcome we saw on the energy side. You then add to that this GNU government that we now have. All of the major parties within the GNU fully support and endorse Operation Vulindlela and their initiatives. In addition to that, we've got a GNU cabinet, which I know isn't perfect, but it does come with renewed energy, sort of revitalization, and hopefully some healthy interdepartmental competition, which could be just what we need to get the economic reform momentum accelerated even further. And you add to that the third pillar of businesses partnership with the Presidency and a Business for South Africa, 3 key pillars: crime, logistics, and energy, and we've seen some really good early successes on that as well. Right, I just briefly, in the interest of time, I just wanted to show you some of the news headlines. So we obviously read a lot as portfolio managers, and it's been so refreshing in the past couple of weeks to have some really good news stories to tell, and these were so easy to find. I mean, I literally thought this is a good idea for a slide, and then opened up a couple of Business Day and Daily Maverick and so on, and these were just automatically available. Some of the call-outs in terms of the new cabinet, Treasury, so important. There was a reappointment of Enoch Godongwana. He's a safe pair of hands. Commitment to fiscal consolidation, music to our ears as bond investors. But also he carries gravitas, both within the ANC, but also the broader government as a whole. And that's really important at this time. Some other call-outs: we know the rising tide of crime and corruption has been so crippling for confidence. We're starting to see, under what we think is quite a strong police minister finally in place, there's quite a nice crackdown on construction mafias, organised crime, and so on. Transnet seeing green shoots in their turnaround plan. Very strong minister there, Barbara Creasy. We think that she's important to drive through the reforms that are required in the logistics space. Trade and industry, that's one to watch. If we look at many of our emerging market peers, they've got very, very good trade policies, which we haven't had for a very long time. So that could be highly impactful on growth going forward. Home affairs, think visa reform. Think skilled workers coming into the economy. Think tourist visas, very, very big employment generating part of our economy. Now, these are really key and moving forward. And on top of that, we do have a parliament which is stronger than it was before, which is important in holding the executive to account. Right, I am running out of time. So if we just then think with a fixed income hat on, through a fixed income lens, what do we need to think about through this theme of slightly higher economic growth into the future, possibly? And I know you're tired of this story, but I always say when you're thinking about bond valuations in South Africa, you have to think about that in terms of three distinct valuation pillars. So we start off with where we are in the global bond market, with the risk-free rate being the US 10-year Treasury. We make an adjustment for South Africa's relative growth, inflation, interest rate cycle, and then we need to make an adjustment for the third R on the right, which is the credit risk premium of South Africa relative to the US, right? You don't have the same credit risk when you're taking on SA government's risk for repayment. How might slightly higher growth impact these pillars? I'm just going to call out two of those. The first one, the risk-free rate. So what's happening with the global cycle? Obviously, stronger growth in South Africa is not going to move the needle globally, right? We concede that. But where it is important is if where we think where we are in the developed market interest rate cycle, we had these big increases after COVID to combat inflation. Interest rates were very high for very long. Starting to come down again. The US is likely to cut interest rates next week. At some stage in the coming cycle, as DM rates fall from these very high levels, investors are going to start to search for yield again. They're going to look to emerging markets to satisfy some of that demand. It's really important that South Africa is seen as investable within that space at that time. And we would argue that as an emerging market with some growth potential, which can repair some of our fiscal concerns, on a relative stage, it's very much a relative game, relative to Brazil, who has huge fiscal challenges, Mexico pushing through very unpopular judicial reforms right now. It's actually so nice. I said to someone yesterday, it's so nice not to be in the naughty corner for a change. Actually, South Africa's looking pretty good on a relative basis, and that'll be important to attract flows at that stage. One more way to think about higher growth, and this has been so critical for us managing bond portfolios over the past number of years, has been the credit risk premium, or the state of our balance sheet. And if you're going to lend money to somebody, you look at their balance sheet. You can do the same for sovereigns. You look at how much debt the country is carrying relative to the size of their economy. That's the debt to GDP ratio. I've graphed that here with a dotted line showing you National Treasury's forecast. And you can look at this and say, well, why so much drama about this? It looks like that's flatlining. Why are you guys getting so overexcited about this? Well, essentially two reasons. One is that as an emerging market, we don't really want to have more than 60% debt to GDP. That's quite a high debt load for us to carry. We sailed right through 60, and as you can see, the forecast stabilizes per National Treasury around about 75%. That's too high. We need that to be lower. And the second issue is that the market, bond investors, haven't believed that line's going to stabilize. They've believed it's going to continue to increase. So how can growth impact this outlook? And I thought I'd just very briefly, I know my time is up, I'm going to be really quickly show you three scenarios run by RMB Morgan Stanley. And all they do is they take different growth forecasts on the left and they translate it into what that debt to GDP forecast line looks on the right. So let's start with scenario one, the green line. That's where growth lifts from 1% to 2%. That's their base case. We get a little bit of less load shedding, some wins on the logistics side. We get to 2% growth. That's exactly what we need to stabilize this debt to GDP line. If, however, we have low growth like we've had in recent years, so we don't get that kick up in growth stagnates, which is really where we've been for the past 10 years, what happens then? The debt to GDP line rises quickly and significantly and almost spirals out of control. Now, this is exactly what bond investors were worried about going into elections, that the wrong political choices and growth policies were going to be implemented. You can see immediately how that translates into a negative outcome for debt investors. If, however, we're optimistic just for a moment, we look at the blue line, we get to 2.6% growth by 2026, so this is the constructive outlook. You can see immediately how that translates into a much better fiscal stabilization outcome on the right-hand side. Very quickly pulls that debt level down. And you're also going to say to me, Mal, 2.6, you told me we were growing less than 1% for the past decade. How could that possibly happen? Charles earlier referred to the BER, Business of Economic Research, Bureau of Economic Research in Stellenbosch. They're a fantastic think tank. They've done some work that if you were to take Operation Vuland Lela's 5 priorities, implement them in full by 2029, we could actually be growing at 3.5% growth rate. So it's not such a stretch target after all. And how would all of that work? This is my little flywheel. We could have a number of different positive translations. So it's so tiny, you probably can't read it. But essentially, if we have accelerated economic reform momentum, which lifts investor confidence, that's what most of this presentation has been about, what else could happen? We could have a stronger currency, lower inflation, which would lead to lower interest rates over time, which would attract investment into the economy, both domestic as well as foreign direct investment. That would lead to stronger economic growth and critically job creation. That's the ultimate litmus test that's going to keep this GNU idea together, is if we see it in jobs. We have a much stronger economy. We're going to harness better fiscal revenues. We could get ratings upgrades instead of those ratings downgrades, lower government funding costs, which would lead into investor confidence rising, which would lead into stronger currency, and so on and so on. Now, I know that it's really, really early days, and this is a journey, but when we, as investors, think about different dynamics in the market, we think about cyclical dynamics, and those are things like, where are we in the interest rate cycle? When are rates going to peak? When are they going to get cut? Where's inflation going to be in 6 to 12 months' time? Those are all cyclical. There are also structural dynamics that we need to think about. That's the long-term direction of travel, or the trend line that cycle is going to move around. And it is possible that we might be at the early stages of a structural improvement in South Africa's risk premium. And it's something we need to think about very deeply and understand as we navigate these upcoming challenges. So I'm here as a multi-asset income fund manager. Can you take advantage of that environment in income funds? Income funds, by their design, are supposed to be conservatively structured. We keep volatility low, we keep risks low. But at the same time, we have a very wide universe of fixed income assets that we can invest in. We don't just sit in cash. And many of those, we are seeing really good opportunities to be able to take advantage of elevated risk premia and would perform really well in a more constructive environment going forward to allow us to outperform both cash rates, but also provide very attractive real returns above inflation. And I'm going to pause there. Thank you so much.
Can I start, Eugene? Ladies and gentlemen, thanks again for the opportunity to talk to you once again. I'm Mike Timotoni. I'm representing Argon Asset Management. I sit as a portfolio manager in the multi-asset class team. Just a little overview on our business. We've been operating for about 20 years. We have a track record of near 2 decades in equities, fixed income, and most recently our youngest product is the flexible income with 11 years. We have a total staff complement of about 33 people. You'll get the rest of the details. The slides will be made available to you. Capability-wise, as indicated, we manage money across different product range, equities, fixed income to multi-asset. Just looking at the setup of our AUM breakdown, equities remain our flagship product, taking up a share of 75% of our overall book. But the products that I'll be representing today, which is the macro products, fixed income and multi-asset class, we have a share of about 8 billion, which is a bit significant. So representing Argon's BCI Flexible Income Fund, I will be sharing our ideas around global macro trends that are evolving, particularly liquidity towards the end of the presentation, because we believe that there has been a dominant driver in risk asset prices ever since the advent of the GFC and the policy responses after that. A bit of salient details on this product that we'll be talking about today. Our objectives there is to maximize total returns through current income as well as capture capital appreciation, mainly done via duration. Investment universe is relatively narrow. We're looking at SA government bonds and credit, as well as money market securities and a bit of derivatives.
From a strategy point of view, duration is the most important lever that we depend on. In the strategy, we also do a bit of credit yield enhancements via credit, as well as a bit of trading around duration positions. We limit our duration exposure to 4.5 years. Credit is only investment grade, and we can take up derivatives up to 20% exposure. Now, starting to the macro, the vast majority of this presentation, I think it has been widely covered in the traditional media that the SARM rule has been triggered, which is really a 50 basis points rise of rolling 3-month unemployment relative to the lowest point in the past 12 months. And as you can see, the red shaded areas denote recessions, and it has a perfect track record in terms of calling this recessions, or at the very least being a canary in the coal mine. So we're paying attention to that. We also look at US economic data surprises. Similarly, it has been a sharp drawdown in the surprise index. Heading into 2024, it started positive, and it has been increasingly disappointing as the year progressed. You look at relative snapshots of sectors that have been contributing to surprise indices. Top panel, I take the snapshot 6 months ago in March. You will see labor market, particularly the most important sector there, personal and household sector, were very positive contributors. I mean, personal and household sector, that is the biggest section of the economy with about 2/3 contribution to the US economy. Those two are now negative, looking at the reading at September the 1st. I mean, it's important to highlight that economic surprises are measured by just looking at whether data actually prints relative to economic expectations, and then you just deflate that by the forecast standard deviation. It says nothing about where absolute levels of data is printing. As we all know, US data is actually printing very healthy levels. Moving along to monetary policy stance, here we are comparing the real Fed funds rate, so lower bound of the federal fund rates, deflated by core PCE, and we look at how it's looking relative to the neutral rate estimated by Thomas Laubach and Williams, who are economists at the US Federal Reserve Bank. Typically, when the spread is above zero, it indicates tight policy stance. And then below zero, obviously policy will be accommodative. You will see now we have seen a sharp incline to just near 2% above real neutral rates, indicating a tight policy stance. But then you look at through history, you'll notice that we've seen this before at 95, and that didn't necessarily lead to a recession. Actually, that's one of the periods where policymakers were successful in engineering a soft landing in the economy. However, it came back to bite them towards the end of that decade in 1999, as we all know, the dot-com crash. The highest the spread has been is in the 80s, during Volcker's period. We can safely say we are unlikely to see those kind of numbers, just given how debt to GDP has evolved throughout the time. There it was probably below 40%. We're talking at levels that are hovering above 130% of GDP currently. Another another measure of policy rate tightness that we look at, this is the Tyler rule, which is a model that prescribes where policy rate should be, looking at a number of factors: deviation from of inflation from target, neutral policy rates, potential growths, and the like. You will see that from this measure, actually policy rate is sitting at roughly neutral levels, what this model would suggest, indicating that actually policy rate might be appropriately configured at this point in time. So just these two indicators, I think it's a bit conclusive to run ahead and say policy is extremely tight. I think the bias is on the tightness, but I don't think it's a clear screaming indicator for you to act abruptly. We also look at US financial conditions. Usually, policy actions transmit through financial conditions, which in turn at a later stage impact outcomes in the real economy. Obviously, interest rates picking up, credit spreads tightening, market volatility increasing will have an impact on spending decisions by firms and households alike. At this current juncture, the white line, which represents US financial conditions, is still hovering in positive territory, so indicating that it's still marginally supportive of US growth. However, it's starting to roll over and we'll be keeping an eye on it. The crux of my presentation today will be focusing on fiscal policy, particularly how the US has been funding their spending initiatives. What I show here is the US marketable debt composition. The key area that I want to highlight here is the blue bars at the bottom. We have seen ever since third quarter of last year, 2023, a sharp incline in issuance of T-bills, and this has consequently resulted in T-bill as a share of outstanding marketable securities to hover over 20%. Historically, the TBAC Advisory Committee have indicated that 20% should be the level that we expect in the long run. They have now breached it, and it looks like it's going to keep heading a lot higher. But why are these people doing this? Okay, simply speaking, the way that they achieved this is skewing issuance heavily in favor of T-bills away from coupon bonds, coupons and notes, right? You can see at the beginning of 2023, the share of T-bills in terms of what was being issued has been in the 70s percentage-wise. That has since shot up to close to 90% in a matter of 3-4 quarters. So clear strategy by US Treasury to suck out duration risk out of the market. And okay, let's just take a step back and assess why these people are actually doing this. And we've just did a simple exercise here looking at the impact of issuance on term premium. The 2 to 3 year bucket was easier to isolate given the structure of the data. So we took a distribution of marketable debt issuance for that 2 to 3 year sector, and we compared it to ACM's estimate of term premium, of the 2-year term premium. You can see the picture here is pretty clear. As you increase issuance of 2 to 3 year bonds, term premium increases in tandem, and over time, we have seen a decline of issuance in those, and as a consequence, term premium has been compressing, now actually hovering in negative levels. Quite interesting and very curious. Looking at term premium versus bond volatility, you can see that the relationship here is pretty clear. Just to take a step back, the MOVE index measures bond volatility across the curve. This is very important for US policymakers because in a system that is increasingly collateralized after the GFC, US Treasuries serve as the quintessential collateral asset. There's also another factor that they've been engaging in, which is the Treasury buyback program. In essence, what they're doing there, reducing volatility further by buying off-the-run bonds and letting on-the-run stuff, which is a lot more liquid, to increase in size relative to what's outstanding out there. So a very clear policy by the Fed Treasury to manage not only duration, but also the volatility in the bond market. How do I show this? So I've put together a very interesting chart here. At the bottom panel, you will notice those yellow bars. They represent a 12-month rate of change of the Federal Reserve Bank holdings of US Treasuries as a percentage of GDP. On the top panel, I'm showing T-bills as a percentage of outstanding US marketable debt. And then the picture here becomes really clear. You can see that these two policy making institutions, US Treasury and the US Central Bank, they've been working in coordination. You will notice whenever demarcated by those vertical dotted red lines, whenever US Federal Reserve Bank holdings of treasuries go negative on a rolling 1 year, on a rolling 12-month basis, almost always you will see issuance pick up in T-bills. So it tells us we already know QE has been very supportive of bond market volatility in terms of suppressing it, as well as taking our term premium. So in essence, guys, we just witnessed here how the US Treasury has been working in conjunction with the Fed in terms of keeping bond yields low. In a way, some people call this financial repression. But now we want to assess how sustainable is this deluge of T-bill supply in the US market. And one of the reasons that they've been able to do this is because they had a huge buffer in the Fed's reverse repo account. Balances peaked at around 2.5 trillion, and you see towards the end of last year and around fourth quarter of October, we started seeing a sharp decline of that, and mainly it was a mechanism that absorbed a lot of those T-bills that came out of US Treasury. Now those balances have been at lowest levels as we've seen since 2021. The kitty is starting to run dry, and I worry what might happen to funding conditions once this runs out. An indicator that I'll be paying attention to that will give us early warning signals that stress is starting to emerge in the money markets. I'm looking at primary dealer holdings of T-bill securities and how that has evolved through time. Again, highlighted in the shaded green areas, those are recession periods, and you can see without fail, whenever there's a recession, you see a spike in holdings of primary dealers of these T-bill securities. They struggle to find demand for these. At current, this has been increasing as Fed reverse repo balances declined. However, I'm not really seeing spikes that are rising my eyebrows. What I would like to see here is about a 2 standard deviation move above the past 12 months level of holdings. So we also composed the recent move in the US 10-year Treasury yield move. So here we're looking at the October 19 cycle top, where 10-year US Treasuries hit about 10%. In the blue line, we show that that is compressed to almost 130 basis points. And then we, in the other lines, we demonstrate what components have been leading to that move. The orange line, as indicated, that represent the 10-year US Treasury term premium. Highlighted earlier that towards the end of the year, shift of issuance towards shorter dated securities, compressed term premium. You can see that initial leg down in US Treasury was mainly the responsibility of US Treasuries sucking out supply of longer dated US Treasuries. However, as we came into this year with inflation becoming a bit of a problem, you can see the white line, which represent the risk-neutral expected short-term 10-year yield, started to push up. However, as those inflation concerns went away, it started to be a leading driver in terms of pushing US 10-year yields lower. So at this point in time, that compression of about 130 basis points could be equally attributed to compression in term premium and lower expectations of risk-free 10-year yields. We also show US 10-year minus nominal GDP growth through time. as theory goes, nominal GDP, US 10-year yield should be tracking nominal GDP over time. However, you can see pre-GFC, when unconventional monetary policies were introduced, it used to be a mean reversion series, sometimes above, sometimes below. However, since 2010, we've seen a persistently low US Treasury yield relative to nominal GDP. Ladies and gentlemen, what we're looking at here is financial repression and stealth. Now, just to conclude and put it all together, liquidity remains a very important factor in terms of our decision-making process at Argon Asset Management. And what I have here in the orange line, I've constructed what we call a Fed net liquidity indicator, obviously taking change in the Fed overall balance sheet and adjusting it for liquidity creating measures in those in the balance sheet. For example, you can see Fed balance sheet contracting, whereas dollar liquidity is actually increasing. For example, when Janet Yellen decides to fund spending by running down the TGA account at the Fed instead of issuing bonds, that's a net positive for liquidity. Another factor that plays in a big role here is dynamics that we observe in the reverse repo account. So the yellow line is starting to head up. We plotted against, on the left-hand side, year-on-year change in S&P 500. So very tight relationship with performance of risk assets. I mean, in my short 10-year career in markets now, liquidity has been the most important factor that we've depended on in generating alpha for our clients. So if you're here and you want to be on the right side of liquidity, we have a compelling product at Argon Asset Management that you can exploit. We've been running the Argon BCI Income Fund for well over a decade. You can see over the past 10 years, we've compounded near double-digit returns, outperforming all traditional asset classes locally. Similarly, 7 years, equally impressive returns, and far ahead of inflation. However, if absolute returns don't matter to you and you want to look at it relative to peers, if peer relative matters to you, I've just taken it out of I've just taken rankings from PlexCron of the multi-asset income category in South Africa, and ladies and gentlemen, lo and behold, this is the fastest horse in the race. And with that, I'd like to conclude my presentation.
There we go. Hi, good morning, everybody. I'm here to talk about fixed income, and I promise I will. But I've entitled my presentation, Pluralistic Ignorance and Death Spiral. So thanks, Eugene and BCI, for having me on the platform. And I promise I will talk about fixed income in a second. And I promise there's going to be tea after my talk as well, because I know it's been a long morning. But pluralistic ignorance, let me start there, is a phenomenon that occurs when people mistakenly believe that everyone else holds a different belief to their own. So I think the best way of illustrating this is by way of an example. You wake up in the middle of the night, or you're awakened by a gunshot. So you wake up and you think, was there a gunshot? Yes, it was. Shall I call the police? And then you contemplate and you say, well, I'm sure one of the neighbors heard it, and I'm sure one of the neighbors will call the police. But I think what's happening here is that all the neighbors are thinking the same thing, and nobody calls the police, and you kind of have this pluralistic ignorance developing, which made me think about our fixed income markets at the moment. And I think there are many gunshots, in inverted commas, that have gone off. And we need to decide how we're going to actually accommodate that and how we're going to act. So I want to take you through a few of those events, just globally, and then bring that home locally as well. I know I said I'm going to speak about death spirals as well, but I'll speak about that in a second, in a little while. But let's just take it globally. I think one of the gunshots that have gone off, and we've spoken about this quite a bit this morning, is our global growth. And IMF earlier on this year said that global growth is in a sticky spot. I'm not quite sure exactly what they mean by a sticky spot, but I think it's kind of saying that we're in a bit of inertia at the moment, and we're not exactly sure which way we're going to go, but there's a lot of sort of positive energy in it. But I think you've got to look at it in its totality, and then you also need to break it down as well, because if you look at developed markets, and I think this was mentioned, or developed economies, let me put it that way, then the expected growth rates is a lot lower than, I think Mal may have mentioned it as well, is a lot lower than your emerging or developing economies. So you've got this disparity that's happening, and I think that's providing a bit of the stickiness. So, you've got global growth where you've got disparity between your developing economies and your developed economies as well. The other thing is that what's also happened within the developed economies, I think there's been this alignment of the output gap, the difference between the potential of an economy and what it actually produces as well. So you have something different happening in the developed economies than what is happening in the developing economies, and that's what's providing the stickiness in our growth environment. And then there was a lot of talk about recessionary fears as well, which we saw come through earlier on this year. I think a little bit of that is abated as we've gone along. I think the July numbers, at the time when I put this presentation together, that's all I had is July numbers, but I know we've seen new employment numbers come out, and that kind of put a bit of a damper on things, but there's been a little bit of movement in the employment numbers that is a little bit more encouraging, and I think there is some positivity that's coming through, especially on the growth side of things globally. Okay, so that's one of the gunshots that have gone. How are you going to act upon it? The other one I want to talk about is inflation, global inflation, and I think global inflation, we've seen that momentum of the slowdown. We've had that slowdown happening, and we've seen that momentum starting to temper and slow down a little bit as far as inflation is concerned. I know we're coming off quite a high base, statistical high base, and of course from that statistical high base, you're going to get lower numbers on a year-on-year basis. But nevertheless, I think we've had higher than average inflation in services prices. I think they call the sequential inflation. And it's only been tempered by, to an extent, by stronger disinflation in food, in the prices of goods. So you have this kind of balancing act that's happening at the moment, where services is being balanced out by the prices of goods. And then we've had this phenomenon where, and I think somebody mentioned it earlier on this morning as well, where food price inflation has come down quite sharply. So this is also another gunshot, if you want to call it that, that's happened. And how are we going to accommodate this? And I think if inflation is trending downwards, if inflation is being tempered by the prices of goods, then this will bode well, especially for our interest rate environment, because we know that interest rates or expected inflation is embedded within things like your bond deals. And Maitzi spoke at length about the US environment at the moment and how that is actually embedded within those yields. So global monetary policy, I think, is the other one. I think it's all on our lips. How is the central bankers going to act? I think the ECB today, and we're all expecting rates to be cut. Are they actually going to be pulling the trigger as far as interest or monetary policy is concerned? I've spoken about sequential inflation early on, and that has sort of helped normalization of monetary policy. And the expectation is that the central bankers are going to synchronize. There's going to be some kind of synchronicity with the central bankers or the ECB. We've already had cuts across the globe, and this will actually filter through to the rest of the central bankers, especially in the developed world. I think where the difference comes is in the emerging economies or the developing world. That might not happen as quickly as we think it might happen, because there's still inflationary pressures within the system. Okay, that's sort of the global backdrop where we've got growth, inflation, and monetary policy. That's the the major gunshots that have gone off, and we need to decide how we're going to act. Are we going to make that call? Because that's our job as portfolio managers. We need to make the call and actually put our money where our mouth is and actually manage the portfolio in terms of the desired performance that we need. So bring that home. I think our local growth scenario, it's still quite fragile, despite a lot of the positive comments I've read and also heard this morning. I think there's still quite a bit of fragility in our local economic environment. Okay, I think that the primary sector of the economy is showing signs, but we've had, and I think somebody said this morning, they don't like the mining sector at all, but the mining sector has also been struggling. So those secondary sectors they've really been also been impacted. And thank goodness we don't have as much load shedding as we've had before, and I think this is quite an important plus in our system at the moment, and I don't want to jinx it, but not having load shedding and having enough energy and power within our system has actually helped productivity, and we've seen that in the last couple of months, which is very, very, very encouraging. But having said that, our consumers still remain very constrained. We've seen the unemployment rates that came out last time. We still have very high unemployment. The consumer, it's hurting in the pocket at the moment in terms of them having the propensity to spend. So these are issues which is hampering our local growth at the moment. And theoretically, that will keep a lid on yields. Because that's, if there's not enough growth in the system, it's going to keep a lid on yields. So in a strange way, in a theoretical way, it's actually good for interest rate assets such as bonds. Okay, then our local inflation environment, we've also once again, similarly to the international environment, we're coming off high statistical base effects, we've had a fuel price which has been moderating inflation over time for us as well. We've seen core inflation also retracing a bit on our side. And of course, I think what is important, somebody mentioned it early on, is the whole inflationary environment that's happening globally. And I think we're not going to be able to steer clear of what is happening globally. And China's been spoken about this morning as well. So that whole disinflationary environment may be absorbed into our side of things as well. Once again, expected inflation is embedded in our bond deals. And if that is trending downwards, it can also be very good for our bond yields. However, if you anecdotally look at things, and I put the chart up there, or that table up there with things that have become very expensive in the last year, and for all our coffee drinkers, and I think the other one is, I can't read that without my specs on, but I think it was things like your rice, that's become quite a few of the staple issues within our inflationary food environment has become very expensive. So there's a lot of balancing factors that's happening, but overall the trend is down. And then just a brief word on our currency. I think that our currency, once again, I'll say it's one of the most liquid currencies in the world. It's traded just about anywhere, so our currency is always very susceptible to volatility. Our implied volatilities of our currency is quite high, but having said that, we've performed very well year to date. Very, very well on a year-to-date basis. The sort of weakness that's come into our currency is because of almost other factors, our political environment, the fact that the MPC had a sort of more dovish stance at the last MPC. We'll see what happens now in September. And that has caused a bit of weakness in our rand, but overall, on a year-to-date basis, even relative to other emerging economies or countries' currencies, we've done quite well, which is good for our interest rate environment, effectively. Local monetary policy is another one of the gunshots that have gone off. Is our SARB going to be cutting rates now in September? I think the trend or the thinking is that they are going to do. Most certainly, we think that there's a huge probability that they will cut rates at the net MPC. But Lesetja Kanayago, I think a week or two ago, said we are adamant, and maybe not in the exact same words, but he was indicating that he's very adamant about inflation being anchored lower before they actually before they act as far as monetary policy is concerned. At the last MPC, they said that this thing, the balance of risk, is now to the upside. Before they said it was balanced. I'm not exactly sure how they calculate that number, but they're now saying that the balance of risk is again to the upside. So there's a lot of little balls that are being juggled as far as inflation is concerned. But having said that, at the end of the day, a monetary policy committee needs to sit and make a decision and vote on these issues. And at the moment, the rhetoric is not always as dovish maybe as we would hope, and there may still be one or two hawks within that monetary policy committee. Right, I promised I'll speak to you about death spirals as well. Now, this is a strange phenomenon, and I'm not talking about the New Zealand and Australian rugby teams, but I'm talking here about a perplexing natural phenomenon where ants essentially doom themselves by circling endlessly until they die of exhaustion. It's a natural phenomenon. There's those pheromones which they touch and they find direction. If they can't find direction, they tend to circle and eventually they die of exhaustion, apparently. And this made me think, we've got one or two of these scenarios within our fixed income environment, and it's really related to our credit spreads. I think our credit spreads have compressed both on a fixed basis and as well as on a floating rate basis. And I'm not suggesting that the credit environment locally is going to implode and die of exhaustion. But what I am saying is that it appears that investors are searching and searching and searching for yield and almost selling their souls to get yield. And effectively the yields are being compressed lower and lower and lower. And it makes me wonder whether this is a potential for implosion. I'm not suggesting that it will implode, but I think that unless we get more diversity within our credit environment, there's always a danger as far as this is concerned. So as any good bond manager, I've got to put up my yield curve, and I think the yield curve is very positive as it stands at the moment, very positive for bonds. And once we get the rate cut, it will just justify an even lower bond yield curve. And we've seen quite a bit of flattening. The belly of the curve as well as the back end of the curve is a beneficiary of this. And the declining inflation risk premium is helping our bonds as well. So I know I'm talking a very positive story for our bond environment, but I do believe that there is opportunity here to capitalize on where we are in the interest rate cycle and also to capitalize on the economic fundamentals that are driving our fixed income environment. So why bonds? There's other issues as well that it's helping the cause for investing in this asset class. And the one is that National Treasury may issue less bonds there might be less issuance than originally thought needed to happen. In our budget in February, I think our budget deficit now stands a little bit less than what it was anticipated that it was going to be, which then means that there's potential for less issuance to happen. And of course, rules of supply and demand, if there's less supply and the demand stays the same, it could be very, very good for our bond environment. And then our fiscal dynamics, even though they've been quite fragile and tentative for a long, long time, there are one or two green shoots that are showing that there's an improvement in one or two of our fiscal dynamics. Debt to GDP ratio, as an example, is still quite high, but there has been indications that, especially as a result of, and I mentioned it earlier, I think it's better productivity as a result of no load shedding. We've had Jafekra, the support that was shown for Eskom, that's also going to be helping the cause as well. And then, of course, we've got a global environment that is quite accommodative as well. A lot of that's been spoken about this morning. Another thing I just want to mention is that there's buyers of our market. I know our foreigners have been sellers, but they're not selling as much. That's number one. And then the second thing, our unit trust industry, and I'm sure we're all involved in the unit trust industry, you know it well. It's burgeoned, it's exploded, and the fixed income component has actually also burgeoned quite a bit. And the unit trust environment is buying our bonds at quite a significant rate, which is also, I think, will help our bond environment. So just to conclude then, I think at the end of the day, we've got to pull all of those things together, look at that gunshots that have gone off, whether it's the economic fundamentals such as growth, inflation, or the currency globally as well as locally. You have to put your money where your mouth is. And this is our chart at Katie's where we have level of conviction. And for a long time, if those bars are above the line, that means we are positive or going long as far as duration assets are concerned. For a good while, we were below the line, but in the last little while, we've seen our strategy and our process, which we believe is all-encompassing and looks at all the factors that drive interest rates has now gone positive. So we are talking a positive story at the moment. And that is translated into just two of our funds I want to show. Our Enhanced Income Fund, which is a Regulation 28 fund that sits in the multi-asset income environment. I challenge you to go and have a look at it. It's a fund that provides exactly what it promises in terms of being benchmark cognizant and beating as well over time. And then we have an absolute yield fund, and please have a look at this fund as well. It's a fund that uses duration to a greater extent, and I think it will benefit from the fact that we are increasing duration within these two entities. So that's it from me. All that is left for me to say is Nzakenza. That's for my colleague, Tsonga-speaking colleague, who helped me put the presentation together. I thank you.
Our next session is on multi-asset or multi-asset funds, and to me that's always a very great session because that's where a lot of these things come together. How much onshore, offshore, how much fixed income or bonds, SA equity, global equity, and some property into the mix as well. Here to share their views and how they look at the funds all the world out there. First up is Tazen Meyer from Visio Fund Management. Tazen will be followed by Simon Deploy from Corian, and Simon will be followed by Henno Vermaak from Granite Asset Management. To all of you, thank you so much for being here today. Tazen, you're welcome to step up. Thank you so much for coming through. Yeah.
Thanks, Eugene. Okay. Good morning, everybody. I think it's still morning. Thanks for joining us today and for giving us the opportunity to both introduce ourselves and one of our best performing funds in the basket at Visio. As Eugene said, it's quite a nice way. In my day job, I'm the co-head of the SA Equity Strategy, and it's quite nice to work on the Balance Fund and see how as a team we can bring together all our best ideas to generate a product that can give you great risk-adjusted returns. So just a quick introduction to Visio and our broader team. The Visio business was started 21 years ago, so we're officially adults this year, by Patrice Moyal. Our roots really lie in the hedge fund business, which were our first funds. We then moved into flexible, and with client demand, continue to expand the offering, bringing in team members with a very diversified experience and length of tenure within the team. If you look at that, you can see just in terms of the asset classes which we offer, 27 years of hedge fund and SA equity exposure, even more in fixed income after having brought in Jonathan Meyerson, who really coordinates our balanced offering and is our fixed income expert. And then with that, offshore property and our Africa exposure just gives you an idea of the diversity of products and the expertise that lies in the team. Linked to that is the fact, just that chart on the right-hand side, they're showing you the mix of styles or educations that we bring into the team, which we think offers us a really unique, diverse way of thinking about markets, thinking about the world. We've got a couple of engineers, we've got a few MBAs, we've got a number of CFAs, and essentially we're not all just finance people sitting together in a team. We try and bring in these ideas and as a team make sure that we have that diversity of thinking to drive what I think is important in particularly a balanced fund kind of offering. So, how do we position and how do we think about balanced funds? Now, as I said, our history is in hedge funds, so risk is always front of mind for the Visio team. But what's quite important is when we started the balanced fund exercise, the team essentially sat and created a strategic asset allocation. We looked at 25 years of history, what would have been the ideal mix of assets to have in your fund to derive our targeted return, CPI plus 5. And essentially based on that, we get in that box on the right there what our strategic asset allocation should have been in an ideal world. Sorry, I see it's been cut off a bit there. Essentially 65, 25, 5, 5. That is kind of how we thought the world should look had you been able to invest in an ideal set of circumstances, knowing what we did at the time of a history. And that essentially is a once-off exercise that set the framework for how we would start to think about it and incorporate our best ideas into this fund. Based on that, we then, on a quarterly basis, so that's not changed. We look at it once a year, make sure we're still on track, but essentially that's the basis for how we look at our funds. We then look at, on a quarterly basis, our tactical asset allocation. What in the market today shows us where we should be best positioned? What has changed? What is changing? What are we most concerned about? What are the big opportunities? And we adjust our portfolio based on that. The asset allocation, as we sit today, is based, or you can see based on the pie chart. We're underweight equities, domestic equities in particular, not because we're negative. In fact, we're pretty positive on the outlook for South Africa. We're just cautious. I think we've seen the equity guys come on and explain the kind of dynamic. We know, we live it every day. We know the consumer's under pressure. We need interest rate cuts to come through. Without that, nobody's going to be out, shopping up a storm and driving a consumer higher. We do look at property and domestic equity as a combined asset, so we look at that together in terms of our asset allocation, and property has actually been one of the places we've made some of our best returns over the last 18 months or so, where we've been very specific about the kind of property we want to include in our funds. Our property team have been excellent at picking the winners within that sector, which has been an incredibly difficult sector, I think, to call over the last 5-7 years. Been very volatile, very unusual, I guess, for the property sector over the very long term. But we found some really unique opportunities that have gone into the funds that have generated the kind of returns that we get there. And then bonds, as I'll show on the next slide, has been really where we've played primarily on our overweight in our balance fund over the last while. And we found some really good opportunities within bonds, but it's really been about where we are in the cycle that has driven how that positioning has fared. So, in terms of the current outlook, I'm going to go very quickly through this because I think you've heard it all morning. South Africa is cheap. There is no doubt that over time we have been the masters really of our own demise as such within the global space, within the local views on equities. And really where we are today is that even post the rally, post the formation of the GNU, South Africa remains incredibly cheap, both versus its own history and versus global peers. And that is the opportunity that lies there today. That said, what we need to see happen is that we need to have a little bit of macro help in getting the story moving. We need the reforms to take shape. We need a bit of support to get the market essentially moving. And how that is happening is inflation is approaching target. We see it daily. We've seen that the next fuel move is probably going to be another large cut that will also help the consumer. It will also help inflation, and they will support the start of the rate cut cycle, which we expect to be shallow. We don't expect a massive or retracement of where we've come from over the last 4 years or so, but we do expect there to be a rate cycle. Unfortunately, we'll have to wait and see what happens globally before we get overconfident about how deep that rate cutting cycle will be, given the fact that we are and inherently linked to global markets. And bringing that together then, how we think about the world. So over the last, let's say, 18 months, 2 years, we've really been in a pause within the cycle. We've had no interest rate cuts, we've had no movement, we've been quite firm about where we are. And hence we've wanted to be overweight bonds and property. And in fact, if you look at the actual performance, so the first is just an estimate over time, over the last 7 interest rate cycles, as to how markets have performed. And if you look at the dots will show you exactly what happened over the last few months, over the last cycle, which is sort of 18 months. And you'll see it's moved very much in line with what history has told us. And hence our positioning over the last 18 months or so, very much overweight property and bonds. It's paid dividends, we've done particularly well, but we've been underweight equities. Where we head to, though, in the next while is that in periods following rate cuts, property remains attractive, and I'll speak a little bit about our property holdings as well, but we really want to be moving more into the equity space. We need to be aware that the environment is going to be far more optimal to be looking at our equities at the same time as we're entering a period where conceivably South Africa could be a very exciting place to be invested. If we just look at this, this is still our presentation from last week in terms of our global asset allocation. Domestic, we are still underweight equity. So if we just look at the domestic column on the left, we're still underweight equity. We are overweight property, not the entire property sector. We are picking specific stocks. We don't think the whole sector is attractive. We want to be very clear that these are going to be very specific parts within the property sector that we want to be exposed to. In fixed interest, we're looking to downweight, but we are aware that there will be opportunities. In fact, in the last while within the local fund, we've very recently increased some of our inflation linkers because we do see a bit of opportunity in the yields there. But and then cash and money market, we're going to maintain some firepower. We think there are going to be opportunities to deploy that over the next coming few months in some attractive opportunities. Then just onto the investment themes and opportunities and how Visio really thinks about the world is that we have 4 key prerequisites before we invest in companies. They relate to cash flow, so balance sheet and sustainable free cash flow generation, because cash is king. In a difficult market, particularly like the markets that South Africa has faced over the last decade, you want to be in companies that despite the macro, despite what potentially legislation or regulation might throw at them, they have the balance sheet, they have the cash flow power to continue operating their businesses and to deliver market-beating returns through making the right investments and having the optionality, and that's really what it's about. So cash, very important, linked to their balance sheet. Corporate governance, as we unfortunately have learned the hard way in South Africa over the last 7 years or so, is a critical factor to consider. If strategically your board and your management team aren't able to align with what's in the best interest of all stakeholders in the long term, you are going to run into problems. We obviously have the big issues. I'm not going to say that S word that is really not well regarded in our team, but certainly, that's sort of the extreme end of the scale. But corporate governance is so critical in understanding how companies think about their future and their place in their future and their ability to continue to grow into that. And then finally, just there in terms of experience management, I think one of the things that has held South Africa in very high regard or globally has been our institutional strength. And we see that within things like the Reserve from a government perspective, from the SARB. But within South Africa, the management teams that we get to interact with on a daily basis, I don't think we can quite underestimate just how powerful they've been in being able to drive continued growth and returns for companies in an incredibly difficult environment for them. And I think they need to be rewarded. Obviously, not all of them. A lot of them have made huge missteps in the last while. But I don't think we can disregard the fact that South African management teams have to be of the best in the world. Chatting to Sea Harvest Group recently, they've done an incredible job in a very tough market. They've essentially been shut out of China for 4 years with the COVID policy. They've made a plan, they found alternatives, they've got new markets they're opening up, and they're getting some of the best product in the world out into the global market from South Africa. Similarly, and I think when we think about our investment themes as such, and just to make it very aware, we don't start with themes and populate them. We start from the bottom up and find companies that then naturally fit into these 4 buckets. We've got the properties, as I said there, you can see Nepi and Fairvest, 2 very different opportunities within the property space, but have formed the basis for our property investment, generating great returns over the last 12 months. But more importantly, I think in the context of what I've just said, are these proven offshore and global companies. When you run a South African balance fund or South African equity product, what we have access to in South Africa are some of the best companies in the world that have their roots in South Africa, and we have access to them on the South African market. Quite often at a discount, quite often great companies that can make material differences to your portfolio. At the moment, we've got a holding in process, so some access to China. China is not necessarily the place you want to be right now, but there will be opportunities, and we think the valuation supports an investment in process. BHP, diversified mining, I think somebody spoke earlier about the opportunity in copper. Iron ore is traditionally a very, very volatile place to be. BHP makes 45% EBITDA margins through the cycle. That's the kind of business we like. They can generate cash flows. They are the market leader. And then Anglo Gold, we've got continued gold exposure. We think that gold is not naturally necessarily where Visio wants to be exposed to, but in the current environment, it's definitely where you want to be. But picking your winners, and our winner we think is Anglo Gold. We have a very large weighting within the business in our funds, and it is our only gold exposure at the moment. And the opposite of that is then domestic champions. I've mentioned Sea Harvest, but things like Mr. Price and Afrimat, which is a business that, again, just keeps on making returns. In a difficult domestic environment, we've got a mining company that can continue to find value accretive acquisitions. That is something that is an incredible opportunity for us to have exposure to. It's one of our longest held positions in the fund. I think we've had it since about 2007, if I'm not mistaken. And it continues to really justify its position in the portfolio. It is an exceptional management team that is proven to operate in some of the most difficult conditions and be able to generate returns. And then we also have a bucket for special opportunities. And these are essentially an array of companies who we're not relying on any specific market or macro environment to move them higher. Essentially what we do is we think there are opportunities here either for turnaround, takeout, or some specific management intervention that is going to yield massive returns. SAPI's been in our funds for some time. We hold it in our bonds as well. We think that this is just an entirely overlooked business that has managed to turn itself around from a debt spiral, absorbing absolutely all of management energy, into an opportunity for being the single largest producer of a product that can take on cotton and give you a sustainable product with long-term high returns. You'll see takeout opportunities in things like Alex Forbes. Raynet is no longer a tobacco company. It's actually exposure to UK pension reform. And these kind of opportunities are really where we want to derive the additional alpha in our portfolios. Just onto the last slide from me, in terms of focused holdings, these are some more of the event-driven opportunities that we see. Pick and Pay, obviously, with the listing of Boxer about to come up. Just to highlight that, the sum of parts suggests to us that there is a very real opportunity in this business. I'll leave it at that. Just to get through to our performance slide, you can see the performance, I think, speaks to itself, outperforming our benchmarks since inception, and certainly year to date, seeing very decent returns out of this product. Thank you, Eugene. Who do I pass on?
That's it. Good. It's still morning. I think it's afternoon already. Good afternoon, everyone. It's a great privilege to be here today. And I'm really excited to present Current Capital to yourselves. Some of you might be a bit surprised to see our name here. And that's because we actually quite recently moved over our funds to the BCI Manco. However, you're on sort of good company. So I've got my partner, David, here, and one of my other colleagues. And David was asking yesterday in the office, who's coming to the conference, and he was asking our other colleague, Anthony, and he unfortunately couldn't make it. And asking some of the other colleagues, and then eventually turns to me and says, so I'm coming. I said, well, I'm presenting, so hopefully I am. So we had a bit of fun in the office, and I think that really sums up our culture. Corin has actually been around since the early 2000s. We were one of the first fund of hedge fund businesses in the country. At that stage, we were part of Bright. We've grown now into a fully fledged investment management business. We've got a DFM offering. We've got a multi-managed arm, and we've also got some funds that are bottom down, single managed. So we've got a broad offering. About half of our 17 billion rand in AUM is from institutional clients. So we look after some large pension funds, and then we also have our retail offering. So that's the disclaimer. So I really want to just speak about our broad offering today in the multi-asset space. So we've got the income fund, the stable fund, and the growth fund. And I think what's encoded in each of those portfolios is to be as diversified as possible. Whatever the return objective is, whether it is, you really want stable returns or, an inflation plus one type environment in an income fund, or you're going for inflation plus 5 in a growth portfolio, what we're trying to do is to give you in as diversified way as possible. And hopefully by the range of asset classes that I'm going to discuss today, that will come through. That's our since inception performance. So the income fund is this year is now over a 5-year track record, and I think that's done phenomenally well versus the benchmark, which in this case is Steffi Composite. The fund's also done very well versus peers. In the case of the stable and the growth portfolio, the benchmarks there is the CISA categories, and again, each fund being able to quite comfortably outperform the benchmark. But let's get into the nitty-gritty. So currently on our portfolios, we on the equity side, we're favoring South African assets on the equity side, and on the international side, we're actually quite supportive of the less favored markets like China and Japan and even the UK. We're underweight the markets, expensive markets like the US and India, and we'll get a bit into that. On the offshore side, specifically the rand dollar exposure, we underweight our offshore exposure. We actually think there's a bit of room for the rand to strengthen. However, it's important to always have a meaningful exposure to offshore assets because it's an important hedge in the portfolio. On the interest rate side, we also anticipating interest rate cuts. I think that's been widely discussed today. So we're still long duration, especially in the growth portfolio and the stable portfolio. We still maintain a healthy exposure to duration. On the income side, we've actually cut that quite a bit because we actually think investors can start having a much more stable return in the floating rate assets. And then lastly, we massively underweight credit, and I've got some slides on that. So starting on the equity side, that's the valuation differential that's opened up between the US and the rest of the world. Now, the basis still is that ultimately your returns are coming from earnings. And the price you pay for that earnings is going to determine your future return. Now, if you look back to sort of the mid-2010s, 2012s, the US and the rest of the world was trading at roughly the same valuation. And yet in the ensuing decade, that's now widened up to one massive differential. And then if you go inside the US, it's even worse, is where 7 companies now is just completely dislocated from the rest of the US market. So when we follow our top-down approach, we actually break down into these components. And you can see how your mid and small caps in the US is far much more attractive than your expensive growth companies. It's actually, I think it was Evan that earlier mentioned how the S&P equal-weighted ETF is such a good buy, and that's exactly what we're holding in our portfolios, because we want to tilt away from these companies that's just trying to price in growth that's not realistic. Just even one example is NVIDIA's run going to continue, and the simple answer is more competitors are going to come to the market. In fact, AMD, which is one of the other chip manufacturers, is in the next 2 weeks coming with their AI chip to come and compete against NVIDIA. Will that change things dramatically in the short term? That I can't tell you. But a company running 80% margins is not sustainable into the future. I really love this chart because it actually just shows you that in the long term, earnings growth is the only thing that matters. Multiple expansion does not give you long-term returns. So the green bars is your earnings growth. So where does your total return come from in an equity? You get your earnings, dividends, multiple expansion, and currency if you're a foreign investor. And over 15 years, the green bars, which is the earnings, is by far the most dominant part. That's what ultimately long-term drives your returns in a portfolio. However, year to date in 2024, virtually all the returns in the best markets have come from multiple expansion. India, Taiwan, which is basically one company, the US, probably to a lesser extent Japan. And again, that's not sustainable. You're betting on such large earnings growth into the future that is not a reasonable position to take, and that we want to diversify away from. And then finally, we sum up our total portfolio positioning and in terms of what we're trying to do it in one chart. Now, this is a bit busy, but we've got those sections in different world regions at the bottom, and then your PE on the left-hand side. And when we say we're underweight US, often the criticism is saying, no, but you have to account that the US will always grow at a higher multiple than the rest of the world. The earnings growth in the US is just higher. And the answer to that is yes, the market has already accounted for that. So if you look at the box over here, the midpoint of the box tells you where that market trades on average. And you can see that the US on average trades at a 16 multiple. Emerging markets on average trade at a 13, and South Africa has hardly had earnings growth for the last decade, is trading at on average at an 11. So just that 5 PE multiple difference is already accounting for the fact that the US has got a much higher earnings growth than, for example, South Africa. So when you go and value these regions, you have to go and check where are they relative to their midpoint. US is way above its midpoint. In fact, the US is now as expensive as at the end of 2021, just before we had a 30% pullback in the market. Now again, I'm not calling for not predicting anything here, but back then the market was considered wildly expensive, and now we're back at that point. So this is the kind of area we would be going underweight. US, and there's a time we would look at markets like the UK, Japan, and emerging markets in general, specifically China, India. Like there's a whole story in emerging markets that we don't have time for today. And I think it also shows why we like South African assets from a different angle that it's been discussed today. So that's the equity side of things, but we're here to discuss multi-asset. So, if we're underweight the world equities and we overweight South African equities, what happens to the balance of the portfolio, the rest of the fixed income side. I think it's been well discussed that we're expecting, the market's expecting interest rate cuts. What will add to that is just the aggressiveness of that rate cutting cycle. So the market is expecting, over 2% of interest rate cuts in the US in the next 12 months. Now, I hope that doesn't happen, because if that does happen, it means we're heading for a recession. So and the reason we say that is that we don't think inflation is coming down nearly as fast as it should. So, we've discussed the growth picture in US, and there are clear red flags showing. So it is possible that we could even already be in a recession. But there's enough earnings growth and there's enough evidence that gives the counter side to it. Our concern on the inflation, though, is that your core part of your inflation bucket. So the first thing is that inflation has trended down, but it started flatlining about a year ago. So even with the inflation number that came out yesterday at 2.5%, we're still not at a 2% target that the Fed wants. And then once you get to the core part of that, you really delve down into what's driving inflation at the moment, and that's your services over here. And that's still running at around a 4%. And that's the concerning bit. So the volatile parts of your inflation bucket, that's drifted down, and in fact, in the most recent number, it's deflationary. But your services, your labor, your wages, that is very, very difficult to get down because no person wants to take a pay cut. That is really what's driving the inflation in the US. So we don't think the Fed has got enough evidence to cut rates aggressively. And if there is an aggressive rate cutting cycle in the US, it is because we're heading for recession. On the other hand, so that's actually to say why we're neutral on global bonds. We think there's room to cut, but maybe not as aggressive as the market is thinking. In fact, you could get a bit of a sell-off in bonds. Domestically, the picture is much more attractive for our bonds. I thought Melanie did a great job of going into the detail of the economics, but just one slide that I think speaks for itself. One market commentator that I follow actually called South Africa, she's an international emerging markets economist, and she called South Africa the fiscal sleeper story of the year. South Africa is the emerging market that's actually currently running a primary surplus in terms of a budget. And the exciting bit about it is it's not that the government promised in February of 2023 that they're going to deliver us, going to run a primary surplus. Is that for the first time in 15 years, they've actually delivered on it. So this came out in sort of May. It was confirmed that for that full fiscal year, we've had a surplus, which was a first. And we're on track for this year to do that again. And I think once international investors start recognizing this, you could see even a further flattening in the yield curve. So, and just to put that in perspective, what could still happen is, the green line is where the yield curve was very steep when we hit stage 6 load shedding last year. Real rates of, in excess of 7%. You can pick up bonds at a 13, almost 14% yield. That's now rallied post the GNU to actually, I think even the long bonds are now below 12%. But you can see pre-COVID, where the yield curve was and the steepness. And it was quite difficult to find a bond that's yielding above 10% back then, even though the short rate was more or less the same. So with continued good news, we can see still further flattening here. Why did we cut duration on our income fund? Because just yesterday morning, we again had a headline. Now GNU is now unstable again. ANC wants to sign the Bella bill into government. The DA is threatening walking out of the GNU. We don't know what that's going to happen there. However, if the GNU breaks up, this curve could easily move up again. So in a fund like a growth fund, where investors are paid to carry that risk over the long term, we still remain overweight our bonds. But in an income fund that's much more short-term focused, we've cut our exposure. And then my last slide on market positioning is credit spreads. So I've got 2 points here. The first one is, and I think Sydney also made this point, is just how much credit spreads have contracted over the last 7 to 10 years. Specifically looking at our bank sub debt, the 81, your first loss after capital, the bonds, your tier 1 debt. What's interesting about this is that back in May 2016, when these bonds first listed, nobody wanted to own them. Like, you couldn't get a manager who wanted to buy it, and this is, firstly, didn't understand the instrument and said something that yields more than equity should not be in a bond portfolio. And now that those same bonds is no longer at JIBAR plus 700, but at JIBAR plus 300, that's a contraction like that shouldn't even exist. Now investors are lapping up these bonds. Now, the problem here is, and I'm slowly running out of time, is that investors get stuck with these bonds and the banks don't call them back. That's the one concern. But I think, maybe just as a last point, which to me was just clearly illustrates how overheated this credit market has become, is that a few corporates came to market in end of July, beginning of August. Looking at the 6-year point, Bukile raised their debt at JIBAR plus 140. That's a small corporate. You're not getting a lot of return for your risk. Sanlam sub-debt, 132. So your seniors get paid first and then you get your capital, okay? But you're getting 130 points. Absa senior, 125. Standard Bank senior, 125. So that's 1.25% above cash. So you could have taken that and taken on a lot of risk or you could take the most secure, highest credit quality paper in the market floating. South African government at 136. So you got 10 points more for a less risky instrument than borrowing to banks. Now, to us, this is complete madness. How does this correct? I've got no idea. This can continue for another 5 years. All I'm saying is when we invest for our investors, we're going to take the least risky with the highest yield every day. So yeah, thank you very much for the opportunity. And yeah, look forward to speaking to you.
Good afternoon, everyone. My name is Zeno Vermaak. I'm from Granite Asset Management, and as the slide says here, we are relentlessly committed to protect and grow your savings. And the way we do that is to follow a multi-asset approach. So it's a pleasure to talk to you about our balance fund today, It's a pleasure to talk about our balance fund. It is one of the areas where we definitely utilize all the skills that we can bring into the mix to create a portfolio to protect and grow savings. However, rather than to bore you with just the balance fund, I thought it might be more fun, if the slides will show us, to talk about food. At a recent presentation, we were asked by a panelist if we had to describe our fund as a culinary dish, what would that be? And after some careful consideration, we realized that nothing that you find on a menu fits the bill. We chose the dish of the day, or the chef's special. You know, that dish that's written on the blackboard on a daily basis that often changes. Why did we do that? For us, we think, why did we do that? We, with some literary freedom, or maybe a lot of it, we can consider our investment team as being the kitchen staff in a restaurant. And what we do on a day-to-day basis is to go out and to find ingredients that we can utilize in the kitchen to create dishes to serve to the people that enter our restaurant. We are very clear as to what we think quality ingredients are and the type of ingredients that we would like to cook with. We also have a team that's quite diverse in our thinking and our experience and our training, and we try to put the two of them together. However, we also know that even the highest quality ingredients shouldn't be used in a dish unless it's ripe and ready for consumption. So what we do is to cast a very wide net. Our team goes out on a daily basis, some of them into the garden to see what we can harvest. Some of them go to farmers markets to see what farmers have produced. We've got people going to specialty stores looking for special ingredients. And we also have some people just going through our own pantry to see if there's any ingredients that we've forgotten about or that has entered that prime use window. Now, once we've done that, and we've gone out, and the team brings back all the ingredients that we want to consider, we enter the kitchen, and this is where the fun happens. We sit together, considering what we have in front of us, knowing the skills that we have, and we start to design a dish that brings in the best that we have to work with our skill set, and we try to play to our strengths. Now, this process is an iterative process. We cook, we taste, we discuss, we change, we add, we take away, we start from scratch, we cook again. The aim of this whole process is just to end up with a dish that we can confidently say is the best that we can have, that we can cook with what we have in front, what we have available. Now, quite often, the dish that we end up with is completely different to the recipes that we considered at the start. And we think that's rational. Ingredients work together in different ways. We want to ensure that what we are working with, being high quality, does work when you consider it at the end as a dish. We also are willing and able to change the composition over time. We do not limit ourselves to just Italian dishes or steakhouse classics or pastries. We try to always reflect reality in what we cook. And that's exactly the same way we go about when we manage the balanced fund. We know very well what we regard as good quality ingredients to include in our portfolio. And what we try to do is to identify ingredients that would firstly increase the likelihood that the fund or the portfolio can compound over time. And secondly, reduce the likelihood that the individual ingredients disappoint when we add them to the dish. We follow an exclusionary approach in this regard, considering 4 elements in part of our research function. We consider the governance of instruments that we look at. We want to be sure that there's less of a risk of a CEO going off on a tangent and not acting in the best interest of shareholders. We want to ensure that the incentivization and the motivation is to our benefit. We look at the balance sheet strength. That does not mean that we don't invest in geared companies. It means that the balance sheet should be appropriate for the industry and the company that we are considering. Management track record is paramount. If you want to be a long-term investor, management will be the main driver of what happens. They make all the capital allocation decisions on your behalf. And then fourth, the cash flow sustainability of the instrument is important. Ultimately, we believe that the value of an instrument to you as an investor is the discounted cash flow that you can get out of that business. So if you're not certain about what the cash flow stream might be like, it's difficult to value. So that's step number 1. What is a good ingredient? The second step then is this ingredient ripe and ready for inclusion or not? And there, for us, is a completely separate discussion to the first one. We want to value instruments. We want to compare what we regard as a sensible valuation to the price at which that instrument is trading in the market. And if there is positive risk compensation, in other words, if we are not overpaying, it is something that we will happily consider for inclusion in our portfolios. This doesn't mean that we only buy at discount. It means that we don't want to overpay, but we want to include high-quality ingredients in our portfolio. The cooking process then in the kitchen is a continuous flow of action. Now, we are focused on quality ingredients, which makes us seem like a bottom-up business. But that's not the full story. We do have a top-down consideration as well, and we see all of it work together. The one major benefit that I have since joining Granite is that I'm part of a true multi-asset and multidisciplinary team with experts in cash, credit, bonds, equities, properties, locally and offshore, all working together to build this portfolio. And we've discussed how we select our quality ingredients, but then adding ingredients into the mix, we need to consider the concentration and the diversification that brings to the mix. You know, it doesn't help that you add something to the dish and ultimately all you taste is tomato. That's not how you build a dish. And similarly, the macro influence or the macro thought that's included in the portfolio is not an attempt to predict any macro variables. We don't position our portfolios based on our expectation of a macro outcome. It's more like if it's a winter's day, a hearty dish makes sense. But in the summer, maybe you want something a little light and refreshing. That's how macro feeds into this, in both the monetary considerations as well as the cycles that we're considering. For us, this process continues over and over. our total team sits together to decide whether instruments are correct, whether the blend that we have in our recipe works, and whether the ultimate taste is good. Now, this balanced fund, the Granite BCI Balanced Fund, was launched in February 2020, just before we went into lockdown. But what you have in front of you is a movie of all the dishes that we've produced since then. What stands out? There are many ingredients included in this portfolio. This isn't a one-trick pony. We've got local and offshore equities, we've got local and offshore property, there's local and offshore fixed income instruments, there's index linkers, there's government bonds, there's credit at times when it makes sense. But the mix, the recipe changes over time, and that's a reflection of how the market changes and how the opportunity set changes over time. This also should show you that we don't have a strategic asset allocation. Our benchmark is inflation plus 5%. That's what we want to deliver. We want to take your pre-retirement savings and increase the buying power of that to the day that you retire and afterwards. That's what it's about. We want to increase that with more than 5% per annum. And for that, we don't need a strategic asset allocation. We act based on what we have in the market in front of us. If we go from the movie to a photo, this is the dish that we had in the end of July 2024. Around a third of the portfolio was invested in domestic equities. Around a quarter was invested in offshore equities. 15% in local government bonds, 17% in total in property, of which 11 was in offshore property and 6 in local property. And then at the top, you see a few herbs and spices added to the mix to round out the dish. Going from the picture to the ingredients, at that day, the top 10 equities that we included in that portfolio is shown on the slide here. And you see some of the themes touched on today is reflected in what you have on that slide. There's some exposure to SA Inc. with Capitec, Nedbank, and ShopRite. There's some exposure to property with Unibail, Redamco, Growthpoint, and Derwent London. We've got some exposure to holding companies that are trading at a discount in the likes of Exor. Afrimat has been discussed. We think it's a phenomenal company. And then lastly, Howden, something different. Howden is the largest manufacturer of kitchens in the UK. And as the importance of the kitchen increases in houses, and as houses get refurbed, Howden's is where you go to when you don't want to do it yourself, but you have a builder to sort you out. Phenomenal business, cash flow generative, long-term compounder, the ideal ingredient for a portfolio like this. Okay, but the proof is in the pudding. So how do our dishes taste, or how have they tasted? We are extremely proud of our track record. It is a short track record. We only started in 2020, as I said, but since inception, we've delivered significantly in excess of our benchmark of inflation plus 5%. We aim to do that into the future. And from everyone in the kitchen, I thank you for your time, and I hope to see you at lunch.
Great insight from the multi-asset managers. And like Dion said this morning, if they all thought exactly the same, there wouldn't be a market. Right. So you have different views, but I think very insightful in terms of how they put it together in multi-asset funds. Our last session for the day is on global multi-asset, where we're going to cover global flexible funds, so a bit of equity and some spice in there as well. We look at global credit. Heard a lot about SA credit today, but didn't hear anything about global credit yet. Is there still value? And we're also going to look at global fixed income. So our panel for the next session is Rory from Vunani Fund Management. Rory, you can come to the front along. Rory will be followed by Louis from Fairtree. You all know Louis very well. And followed by Brandon Quinn from Saffron Wealth. Rory, thank you so much.
Thanks, Gene. Let's make sure this is working before we get going. Which one am I pushing? Right, I think with all that talk about cooking and ingredients, I would have insisted in going after Heno if I'd known the content of his presentation. I'll start with an admission. I'm very much an equity investor, and so I feel that the imposter syndrome looms quite large being on a multi-asset panel. But I thought what I'd do is contrast our approach to our global flexible fund, which is admittedly very equity-centric, to the traditional multi-asset approach. So what you won't hear is views on broad asset classes, but rather I'd like to leave you with an idea of how we approach our fund, the asymmetry with which we attempt to deliver the returns within the fund, and how that contrasts to the traditional approach. And I'll conclude, I think, with hopefully some helpful information on how it might benefit your clients, particularly in terms of how they experience and react to those returns, which I think is quite important. Right. So your traditional multi-asset approach is your sort of typical 60-40 equity bond benchmark. Despite sort of a lost decade for bond investors, that's delivered a very reasonable outcome. And particularly when you consider the objective of diversification, that's to harness, uncorrelated returns, reduce drawdowns, and ultimately deliver superior risk-adjusted returns, which you see in a higher Sharpe ratio. So your traditional approach has done a pretty good job over time. We tend to think of returns as symmetrical, but I think we all also understand the maths. Losing 20%, you have to make 25% back just to break even. And in terms of our approach, considering margin of safety, and as stewards of capital, we are very much focused on delivering an asymmetry in the returns. And that adds up as much to participation in the upside as the downside. And this is really the message that I want to leave you with today, is we tend to think about returns in the positive sense and risk in a negative sense. But there's both up and downside risk. And what we're looking to deliver is an asymmetry in the returns. It means that if we give up some of the upside as an opportunity cost, we make sure that we make it back and then some on the downside. So we tend to play defense very well. And there's a number of ways in which you can do that. So what I've done here is just modeled out a 80% upside capture, 60% downside capture equity portfolio. In other words, if the market did, was up 1%, and you achieved 80% of that outcome, but when it was down 1%, importantly, you only achieved 60% of that downside, your downside capture. Over time, that asymmetry compounds in quite a meaningful way, and you can see that reflected here relative to your traditional equity index, the all-country world, and the 60-40 bond benchmark. And more importantly, obviously, the superior risk characteristics or features that comes with, both in terms of drawdowns and significantly enhanced Sharpe ratio. So that concept is what we're looking to deliver in our flexible fund. So philosophically, what are the sources of asymmetry? For a flexible fund manager, the first one is not having to be fully invested. There are times when sitting on the sidelines does make sense. We are very much bottom-up informed in terms of our risk tolerance. So we track our global equity buy list, 100 stocks on that buy list. We track the intrinsic value discount on a day-to-day basis. We can tell you how attractive the opportunity set is, and that informs risk tolerance in the fund and the equity exposure that we take. The ability to diversify across asset classes, even though we are quite equity-centric, there's a big basket or an opportunity set to choose from, and we utilize that. Capital structure arbitrage, maybe less familiar in the South African context because we have very narrow markets, but things like convertible bonds, preferreds, that sort of thing, where exposure to the same underlying risk can be achieved by arbitraging the balance sheet, for example, or finding a better risk-adjusted return from the same underlying drivers. And then the second half of this slide is really assuming or approaching a margin of safety in a multi-layered fashion. So we tend to think of it numerically, a discount to intrinsic value, but our process is focused very much firstly on quality, understanding the quality of the business, the strength of its competitive position, insisting on investing only in durable businesses and companies with strong balance sheets. And that creates that multi-layered approach to margin of safety. We don't delude ourselves into thinking that you can understand or calculate the value of the kind of complex and diverse companies that we invest in to the second decimal point. And therefore, we are resolutely scenario-based in our approach and approach valuation in a probabilistic way. So, multiplying out the probabilities we apply to bull cases and bear cases, rather than centering on one particular outcome. And so, what we attempt to do in that sense is to narrow that sweet spot. Or, Dion talked this morning about grayness. It's all shades of grey. But how close can we get to the sweet spot in terms of valuation? And that obviously enhances conviction. And then the last thing, and this is the most important one, I think, is a disciplined adherence to that process. So it's very easy in a spreadsheet to model out 80% of the upside and 60% of the downside. In practice, it's obviously far harder to do, and that requires both very clear process, but the discipline to stick to that too. So the characteristics I described in the second half of that last slide, speak very much to a quality factor and the quality premium that one can harness. And so I just thought to contrast here the All Country World Quality Index to the MSCI, and you can see that the quality factor gets you some way towards the asymmetric theoretical portfolio, but not quite all the way there. And that probably then again speaks also to the benefit of the flexibility that comes with a mandate such as ours. That results in drawdowns very similar to a balanced fund, the 60-40. And then you might think, well, the compounding effect over 25 plus years, that return profile doesn't quite look the same over a shorter period. So what I've done here is just showed in a scatter the return on the y-axis and the volatility that return came with for the various sort of buckets. And what's most interesting here is that you sort of back out the break-even upside capture ratio required to meet the market return. And that tells you how much of the upside you can forego, assuming you only capture 60% of the downside. And that number is, over any one of these time periods, closer to 70%. So in a market environment such as the one we've been in, where the MSCI has delivered returns of 20 to 25% in dollars, over the last year or more, we've been quite comfortable with an absolute return of 20%, in the full knowledge that philosophically and in terms of the process, we will recoup all of that underperformance or relative performance on the downside. The market, MSCI, peaked on the 17th of July, declined 8%, subsequently rallied 9%, and month to date it's down about another 3%. All of the relative performance that we gave up over the past 12 months, we made back in less than two months. And that speaks, I think, to the style, and it speaks to an adherence and an application of that asymmetry. Now this, as advisors with clients, I think is what I'd like to leave you with. You might be familiar with a study in US mutual fund investor returns. It's done by an organization in the US called Delbar. What they do is they analyze redemptions and subscription information from US mutual fund investors, and then from that data are able to determine the average mutual fund investor return, balanced fund investor return. I've seen this done over a number of different time periods. This is the most recent one I could find. The average investor underperforms the opportunity set dramatically. You can see the 60-40 typical balanced fund portfolio roughly in the middle there. And then over the 20 years to 2021, REITs and emerging market equities have done quite well. I think we rolled that forward to today. The leadership might change, but your asymmetric portfolio clearly does a much better job. And this, I think, is the message that I'd like to leave you with. How do your investors experience the returns? How do they react, particularly in sharp drawdowns? And if you haven't considered a flexible fund, and I'll speak generically about the group, I think the value is in keeping your clients invested at exactly the points when they're probably looking to make changes. And that's generally at the point of extreme drawdown. And the result that you see here for the average investor is almost certainly a function of the fact that they buy high and they sell low. And so within a flexible fund that has the ability to deliver equity-like returns with downside protection, or if you can perfectly deliver on the 80-60 promise, significantly better returns in the equity market with much better risk-return characteristics, then not only do you keep your clients invested and they experience the upside, because generally they also take too long to get back into the market, but the ride is clearly far more comfortable, and we avoid all the behavioral pitfalls that clients fall into. And that's really the summary of what I've just said. So the benefits of a flexible fund: not having to be fully invested, the ability to diversify across asset classes, low volatility and drawdowns, you'd expect that. But then the frictional costs of having to switch and also to make the asset allocation yourself or your client having to do that, that's in the hands of somebody else. And then most importantly, keeping them invested. So I think that leaves me with 2 seconds. Thank you, Eugene.
Hey, good afternoon. My name is Louis Antelme. I'm going to talk to you about the BCI Fairtree Global Income Plus fund. It's a bit of a mouthful, but in any case, so because it's a credit fund, I'm going to talk to you first of all I'm going to start with credit as an asset class, because it remains a valuable source of uncorrelated risk premium that you can earn. I'll tell you a little bit about the fund, and I'll show you the performance, and then what I think you can reasonably expect from the fund going forward. So if we have a look at credit, this is the iTraxx Crossover Total Return Index. It's a European high-yield credit index of the 75 most liquid European corporates, all equally weighted. And this is since inception on the 29th of June 2006 when the index started. It's a total return index, so it's net of all credit losses, and it's 18 years worth of data. And then I've plotted it against a 3-month Euribor total return index. So 3-month Euribor is just 3-month interbank euro rates. And you can see over the time period, it's generated 440 basis points, or 4.4% of credit risk premium over the previous 17 3/4 years, which is a pretty good return, with annualized standard deviation of quarterly returns of about 9.18%. Now the scale is a bit problematic here because, as you know, for a lot of the time period, Euribor was flat or even negative. So it's probably easier to look at it as the iTraxx Crossover Total Return versus 3-month Euribor plus that realized credit risk premium. And you can get a better idea of how it's performed. Now, you could argue that you've benefited from strong performance that you had here between September of 2011 and March of 2015, which is certainly true. But even if you got in at that intermediate peak at the end of March 2015, you've still been able to realize a credit risk premium of 274 basis points for the previous 9.25 years. Now, by way of comparison, but the most compelling reason to include credit in broader portfolios is that it's not correlated to other asset classes. In fact, it's not even correlated to policy rates. This is a chart of the federal funds target rate in green and the European Central Bank main refinance rate in blue. And then along the bottom, the little orange bars are defaults or credit events that have triggered credit default swaps. Now, credit default swaps are purely credit insurance for bond investors. And you can see that just by looking at the chart, I mean, first of all, you can see there's a strong correlation between central bank policy rates, but not much correlation between policy rates and actual defaults. Because if you have a look at the steep rise in policy rates from the beginning of 2022 and the fact that they've remained up here for an extended period of time, defaults or credit events have been conspicuous by their absence. In fact, there have only been 2 this year. There were 3 last year. And even if you go back since 2020, there have been 18 defaults. Of those 18, 8 are leveraged Chinese property companies. 3 of them were sovereigns. 1 was a Russian company. And only 6 of them were actually corporate defaults, split between the US high yield market and the European market. And then also, if you have a look, during this long period from the end of the global financial crisis or the start of the global financial crisis in 2008 to the end of 2021, where you had rates that were really very low, close to zero, you would have expected that defaults would have been, much lower than the sort of long-term averages, which hasn't been the case. If we then, compare, other asset classes and the returns you've been able to generate, this is, if we look at European sovereign bonds, what you would have generated from them, this is using the S&P European Sovereign Bond Total Return Index, again versus the 3-month Euribor Total Return Index. Over the same time period, so nearly 18 years, you've realized a term risk premium of just over 1%, 1.18%. With obviously much lower volatility, standard deviation of 4.8%. And similarly, if we look at equity, what you've been able to generate from equity, this is the Eurostoxx 50 Total Return Index. Again, over the same time period, it's given you 4.12% per annum over the previous 17.75 years, but with much higher volatility. So close to 19% annualized standard deviation of quarterly returns, 18.86%. So what is this fund